If you're in a place where you're earning money but you feel financially stuck because you just don't know what to do with your money to get to the next level, you are not alone. The inspiration for this video came from a conversation I had with my friend just a week ago because we were talking about money, and he was telling me about how when he got his first job, which wasn't that long ago, he really had no clue where to start with his money, and he came onto our channel and he was still kind of overwhelmed because he didn't know where to start. So I figured, okay, this would be a good opportunity for me to go out there and really just put out a video that will lay out the foundation of how to use your money from A to Z. This video is going to be a little bit different than my other videos because I don't have a script. I just have the 10 different things that I'm going to be talking about, and everything else is just me. So I'm about to grab my whiteboard, that way I can draw it all out. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. The very first thing you gotta do before you worry about investing your money or budgeting your money or doing anything is you gotta calculate and figure out how much money is coming in and how much money is going out. If you do not know how much money you have coming in and out, you are just going to be one big question mark when it comes to money. So I want you to pull out a piece of paper, pull out your pay stubs, pull out your credit card statements and your bank statements, look at how much money you have coming in every single month, and then look at how much money is going out. This is going to give you a good idea of just kind of a broad picture overview of where your finances are right now. The reason this is so important to start with is because the majority of people in America are living a life where they have $1 coming in, and for every dollar that comes in, they have $1.20 going out because they're financing their life with credit cards and lines of credit and debt. The crazy thing is that there's a lot of people that don't actually realize that they're living like this because they're just making the minimum payments on all their cards and their debt payments, and so they're making money and they're making the payments thinking that everything is okay because they never actually take a look at their finances. So what I want you to do is literally just take a piece of paper and draw 3 columns on it. Draw one with how much money is coming in, so your income. Draw one with how much money is going out, so this is your expenses. And then draw one with where else this money is going. So are you investing? Are you saving? Where else is your money going? Maybe it's charity. You got to know exactly where this money is going. Once you got that piece of paper that shows where all of your money is going, keep it, because you're going to be looking at that every single month, because I want you to do this financial analysis of your money every month. That way you can see how you're improving on your finances. I used to guest teach in Detroit public schools. I love teaching. And I used to go to these schools to talk to the kids about entrepreneurship and just general money management. And one time I asked the class, how many of you kids are working a job right now? And almost every kid in the class raised their hand. And then the next question I asked them was, how many of you have a bank account? And out of all these kids that had their hands up, there was like 2 or 3 that maybe kept their hands up. They had all these kids that were going to work, getting a paycheck, but they didn't have a bank account. So what they did was they would get this physical check from their job, and then they would go to the liquor store, pay the liquor store owner 10% of their check to get their cash. So if you made $100, your liquor store owner is going to take $10, so you got $90 left. And then on the way out, you're going to buy chips, you're going to buy pop, you're going to buy a bunch of other dumb things, and then by the time you're out, half your paycheck is going to be gone. Banks are in the business of making loans, okay? The way they make money is by keeping you in debt. You need to understand that. This doesn't always mean that you should just avoid banks or never use them. That means you need to know how banks work. That way you can use banks to your advantage. You need to have at least 2 different bank accounts. You want to have a checking account and you want to have a savings account. They have 2 different purposes because they have 2 different uses. These 2 are the bare minimum. Once you get more involved on the investing side of things, you might open up a 3rd bank account to hold your cash for your investments, but let's just focus on these 2 for now. So your checking account is the money that you're going to be using for spending. So if you have a credit card or a debit card, this card is going to be linked to your checking account because checking accounts let you do a lot more transactions in that bank account. So this checking account is the cash that you have to spend every single month. Your groceries, your rent, your shopping, all of that goes out of this account right here. Your savings account is your savings money. This is not the money that you use to go buy groceries from. The savings account is the money that you're either going to be saving for a big purchase or for your emergency fund. You should actually have two different savings accounts if you're going to have this emergency fund and you're saving for a big purchase like a down payment on a house, because you don't want to commingle the two. You need to have an emergency savings account. This is the money that you use for emergencies only. So if you lose your job or if a tragedy happens, this is the money you have for that. This should be its own savings account, and if you're saving for something like a house or if you're saving for something big, that should have its own separate savings account. Checking accounts and savings accounts have different rules at banks. Like I was kind of mentioning earlier, you can do a lot more transactions in and out of a checking account than you can do with a savings account. So with the savings account, a bank might say you could only do 6 transactions a month, and if you do more than 6 transactions a month, just for an example, then they're going to charge you a fee. Savings accounts also sometimes pay you a higher interest on your money because the bank knows that the money isn't going to be leaving your savings account as much as it will your checking account. The tricky thing with that in the environment that we're in right now in this economy is that we are in a very low interest rate environment. So what that means is if you go out and take a loan, your loan is going to be a very low interest rate, which is good news if you're borrowing money for something good. But the downfall is your bank is going to pay you a very low interest rate on your savings. There used to be a time when banks would pay 2, 3, 4, 5% interest on your savings. Now, you'd be lucky if you get 1% interest on your savings. One thing that you can do here with your savings, and one thing that I do with my savings, is because I don't use my savings every day like I do my checkings account, you can move your savings money into a high interest online savings account, because these online banks have lower overhead fees because they don't have all these like retail branches everywhere. They don't have to pay for tellers and all of that. So they don't have all these retail fees, so they can pay you a higher interest on your savings. Now, it's not anything crazy. It's not going to make up for an investment or anything like that, but it's better than what you're getting at most traditional banks. By the way, I'm going to be talking about a ton of different topics throughout this video, and if there's something that you want to learn more about, like high interest savings accounts, I'll put more resources for you in the description below. Okay, so you want to have a minimum of 2 different bank accounts, your checkings account and your savings account. And what you want to do is when you get your money direct deposited into your bank account from your job, what you should do is create an automatic transfer that moves money from your checking account to your savings account automatically. That way every single month you have money being saved without you having to touch it. That way you know, okay, I don't have extra money to spend because this money has already left your account and it's already been saved. That way you can't accidentally spend this savings money on a brand new TV. Many banks offer features like this for free, so make sure you ask your bank, and you also want to make sure that your bank is not charging you a monthly maintenance fee. So my grandma, who doesn't really speak English, had a bank account with Bank of America for 15 years. And one day, this is actually not that long ago, I went to kind of look at her financial bank statements with her, and I found out that Bank of America was charging her, I think it was $15 a month as a monthly maintenance fee for doing nothing, essentially. So for the last, I don't know how many years, they were charging her $15 a month for no reason, and she kept paying it because she doesn't know that there was alternatives out there. You do not need to pay a monthly maintenance fee just to use a bank account, okay? We are in a new digital age where these type of fees are just, you don't need to do that, okay? So make sure you do your research on your bank. Look for the different bank accounts that you can have. Create a way that when you get paid, you automatically have money moving to your savings account. And if you have a separate bank account for your investment cash, do the same thing for that. That way your money is automatically going to the places where it needs to be. And do not pay any fees that you do not need to pay. Third, let's talk about debt, because not all debt is the same. If you have any sort of high interest debt, so these are things like credit cards or hard money loans, if you have this type of high interest debt, then your sole focus in the beginning right now should be to pay off this high interest debt. All your friends are probably talking about how much money they're making by investing in Tesla or this other hot stock. This should not be your focus right now. Right now, the only thing that you should be doing with your extra money is paying down this debt, because when you have this type of high interest debt where you're paying 10, 12, 15% a year in interest, then your money is compounding and building wealth, not for you, but for your credit card company. You need to pay this off as fast as possible and use every extra penny that you can to pay off this high interest debt. Do not worry about investing. Do not worry about doing anything else until you pay off this high interest debt. I mean, to be honest, you should not be going on vacation. You should not have a Netflix subscription. You should not be eating at restaurants if you have credit card debt. If you have this type of high interest credit card debt, you need to be laser focused to pay down this high interest debt first. So when it comes to debt, you want to get rid of it as fast as possible possible, and you want to stop fueling the thing that got you into this debt in the first place. If you cannot control your spending, get rid of your credit card until you can control your spending and until you can pay down this debt. The secret to building wealth is not by pinching pennies. It's by using your money strategically to buy things, assets, which are things that are going to make you more money. This is what investing is all about, and anybody who wants to build wealth has to invest their money. But just like how all debt isn't the same, all investing isn't the same. The first thing you want to do when it comes to investing is put aside some cash that you can use towards your wealth building fund. This is the money that you're going to use to make yourself wealthy by investing in this money. And the second thing you have to do is you got to ask yourself what your risk tolerance is. If you have any sort of low interest debt, so these are things like a car payment or a mortgage or student loans, one of the things that you can do to invest your money and get a guaranteed return is pay off your debt early. Because let's say you have student loans that's charging you 6% a year and you pay off your student loans 2 years early. That's 6% you're going to get on your money guaranteed during this 2 years, because that's 6% interest that you do not have to pay to the bank. This is the least risky way to invest your money because you're getting a guaranteed return on your money. If you don't have any sort of low interest debt or you want to take on a little bit more risk, then you can put your money into the market. Now, when I say put your money into the market, everybody assumes I mean that you need to go and start picking stocks. But the majority of people shouldn't actually be in the stock picking game. There are other ways that you can invest your money into the market without actually picking stocks, by investing in something called an ETF. An ETF is essentially a fund that gives you exposure to multiple different stocks. So now, instead of you going out and trying to find the best stock to invest in, you can invest in an ETF or a fund that's going to give you exposure to the entire stock market. Now, if the stock market goes up, your fund goes up. If the stock market goes down, your fund goes down. Or if you want to be a little bit more specific or technical, you can invest in an ETF that gives you exposure to the tech stocks, or an ETF that gives you exposure to healthcare stocks. So this is a way for you to now invest your money and get the returns that you get in the stock market without actually having to pick stocks. If you want to be more involved with your investments, then you can look at investing in something like individual stocks or real estate. Now, like I was saying before, the further you come down this, the more risk there is. Like paying down debt has the least risk. Investing in an ETF has a little bit more risk, and investing in individual stocks or real estate has even more risk than that. But more risk comes with more potential. Not always more return, but more potential return, because you can invest in a company right before it goes big, or you can invest in real estate in a location where there's a lot of demand coming and there's a lot of developments coming, so the value of your real estate goes up and your rental values go up. Again, this is now going to depend on what your financial goals are, and you have to be honest with yourself. What kind of life do you want to live financially? If you really want to live large and do these lavish things, and all you're doing is just paying down debt with all of your extra cash, you are going to have a tough time getting there, because you're going to need to earn more money. Yeah, you also have the potential to lose more money because you're taking on more risk, but if you don't take that risk, then you don't have the opportunity to get towards your goals. You should also understand the different ways that you can make money through your investments. So when people invest in the stock market, most of the time their goal is to buy a stock today for, let's say, $100, and then 5 years from now or 10 years from now sell that stock for $200 or $300 or whatever. So you're buying an investment today at a certain price and you want to sell it at a much higher price in the future. With real estate, it's very different. You're buying real estate not to just flip it for a higher price. You're buying real estate now to get rental income. So you're creating passive income with real estate, because you can go out and buy a house or buy an apartment complex or something, and now you're going to have tenants living there, and these tenants are going to pay you rent every single month. So if you buy a property and you lease it out for $1,200 a month, you might make $700 a month in profit from that property every single month, as long as you have a tenant living there. So this can help create you passive income. You can do the same thing with stocks through dividends. But a lot of times when people invest in stocks, they're looking for that appreciation. So they want to see that price growth. So you got to know what kind of goals you have when you are investing your money. Now, number 5, spending. When it comes to spending, the first thing you have to understand is the difference between an asset and a liability. An asset is something that puts money into your pocket. A liability is something that takes money away from your pocket. So now, when you're spending money, you got to know what you're buying and you got to know where your money is going. Is your spending taking all of your money away from your pocket, or is your spending bringing money back into your pocket? Most of the things that we buy are liabilities. So your clothes, your shoes, your cars, everything that you're wearing and showing, these are all liabilities. Because when you spend $100 on a new shirt, or you spend $40,000 on a brand new car, that money is gone. And if you try to sell that thing, you're not going to get your money back. Like, even if you go out and you buy a brand new car today for $40,000 and you drive it around for a couple of years, when you go to sell it, you're not going to get anywhere near the $40,000. And if you bought a brand new shirt for $100 today and you try to sell it, you're not going to get $100 for that shirt. So liabilities are things that take money away. Assets are things that put money back into your pocket. These are what we just talked about, investments. So stock market investments, real estate investments, these are things that you buy for the purpose of making money and building wealth. If you really want to become wealthy, you got to be buying more assets than liabilities. The only way that you can do that is by spending less money on liabilities. That way you have more money to spend on assets. Right now, the majority of people are living paycheck to paycheck because all their money is going to liabilities and then they have no money left over to buy assets. So what I want you to understand when it comes to spending now is if you are buying a liability, so if you're buying a car, you're buying anything that's not putting money back into your pocket, you are no longer allowed to finance it. Period. Okay? The only thing that you can consider financing here is your own home, but your car, your clothes, everything else like that, no more financing it. No more store credit cards because you don't have the money to buy it. No more paying 0% APR for something because you don't have the money to buy it. Now, I know what you're thinking. 0% APR, what's the big deal about that? You're not paying any interest. Yeah, but there's a reason why 0% APR is so profitable for businesses and banks. 0% APR works because they know that if you go into a monthly payment plan on something that's $1,000, so you're buying this brand new phone for $1,000 and you're going to pay it off 0% APR for the next 1 or 2 years, well, what's going to happen? That means you don't have $1,000 to buy the phone today, so you are going into debt to buy the phone, and the majority of people are not going to pay it off in time, so now you're going to get slapped with a big fine at the end of your 0% APR period because you didn't pay it off in time. And you also think that you have more money to spend right now because you didn't have the pain of $1,000 leaving your wallet today. So yeah, you might not be paying any interest on that money today, but you're also not feeling that pain of the money leaving your account, so you're more likely to go out and spend more money on liabilities that you shouldn't. Don't play that game. If it doesn't put money back into your pocket, buy it with cash and don't worry about it. And the way that you know what you can afford when it comes to liabilities is by following our rule of 5. If you cannot buy 5 of them, you cannot afford 1 of them. If you follow that rule when it comes to liabilities for things that you do not need to survive, you will have more cash to buy more assets, which are going to put more money back into your pocket. Going along with spending, let's talk about credit cards. Depending on who you are and depending on your spending habits, credit cards can be your biggest enemy or your biggest ally. I love credit cards. I try to only make my purchases on credit cards because I get cash back, I get free perks, I get free rewards, and I get free purchase protection. So when I buy things, I buy it with my credit card because I get all these rewards, and I know that I'm always going to pay my entire credit card balance in full every single month. That way I never have to pay a penny in interest. If you want to use your credit card the right way, you need to first understand how your credit card company makes money. That way you can understand this, and that way you can use your credit card in a way that's going to benefit you. So every time you swipe your credit card is going to charge the store a fee for processing the payment. So if you go to Walmart and you check out with your Visa, now Visa is going to charge Walmart a fee for processing this transaction and for processing this money. So every time you swipe your card, the store owner is going to get charged a fee. They might charge your store 3%, which is why the credit card company can pay you 1-2% cash back. The second way your credit card company makes money is through APR. So if you don't pay off your credit card and you got to pay your credit card company interest, then your credit card is going to make a windfall because they're going to get a crazy interest rate on money that you are not financing from your credit card. You never, ever want to get into the game of paying this APR for credit cards, okay? This is always a losing transaction. So if you're using a credit card, you need to treat it like a debit card. That way you're only buying things that you normally would with cash and then pay off your entire credit card balance in full every month. That way you never have to pay a penny in interest. Now, if you're not going to get charged an extra fee to use your credit card, you might as well use your credit card because your credit card is going to charge the store a fee and then they give you a kickback for doing that. That's what your rewards are. So if you go to Walmart and you buy $100 worth of groceries and you swipe with your Visa, Visa might charge Walmart $3 to process this transaction, and if you use a Visa, they might pay you back $1.50 in cash back just for using their credit card. If you didn't use your credit card, you'd have to pay Walmart $100 in cash and you wouldn't get any cash back. But because you used your Visa, you got $1.50 back. But this only works if you understand how to use a credit card the right way and if you can control your spending. If you cannot control your spending and you don't think that this is going to work for you because you are going to overspend or you're not going to pay off your credit card, then don't use your credit cards. The rewards are not worth it. But if you know that you're never going to pay a penny in interest because you're only going to buy what you can afford and you will always pay off your entire balance in full every single month, then get a credit card. That way you can get your rewards. Once you get to this point, now you are really on your path to wealth, and now is when you want to start thinking about how you're going to protect your wealth and pass on your wealth. This is what estate planning is all about. Now, I am an attorney, which is why I want to talk about this, but I am not your attorney, so if you do have specific legal questions, talk to a professional in your area. So the first thing when it comes to estate planning is you got to think about, okay, when I die, because I know eventually everybody will die, it sucks to think about, but it's reality. When you die, what do you want to happen to your assets and your money? Who do you want to get it? So this is what a will is all about. A will essentially tells the world, okay, when I pass, this is what I want to happen with all of my money. You do not want to get into a situation where you die without a will and you have these assets, because now this is going to create fights within your family. It can create a whole bunch of issues, and you do not want the state to decide where your money goes. Another option is you can create a trust, which essentially tells the world what you want to happen with your money after you pass. But again, this is what a professional can help you with depending on your personal situation. So you need to have a will or trust. That way you can dictate how your assets are going to pass. Second, if you are building your wealth and you don't have this wealth built yet, you need to have some sort of life insurance in place to protect your family from a tragedy. The way life insurance works is if you were to unexpectedly die, then life insurance will come in and they will take care of your family financially because you're going to buy this policy. So let's say you buy $1 million policy, you're going to be paying this policy every single month, either for a certain number of years or for the rest of your life, depending on what kind of plan you get. And so you're buying into this policy, and if you were to unexpectedly die, then life insurance is going to come in and they're going to give your family a big check. So if you buy a $1 million policy, they're going to come in and they're going to give your family a $1 million check. Personally, I look at life insurance the way I look at car insurance. It's there as tragedy protection. It's risk management. It is not something that you want your family to rely on to survive after you. Your goal should be to invest your money and build wealth with your own assets. And if something tragic were to happen along the way, that's when life insurance comes in as that bridge, and they can come and take care of your family, because you never want to run into a situation where somebody who is a breadwinner of a family tragically dies, and now this family already has to deal with this heartbreaking loss, but now they don't have a way to pay their bills. And what I think a lot of people overlook is how affordable life insurance can be. Like if you are a healthy 30-year-old male, you can get $1 million life insurance plan for something like $30 a month. If you are making money, you need to pay taxes. And even if you think you're not making enough money to really pay taxes, you still need to file a tax return, because that's just the way the government works, okay? If you do not pay your taxes or you do not file your taxes, it is a big issue. You can go to jail for doing that, so do not play that game, okay? If you are making any sort of money, you have to file a tax return. If the money you're making is just coming from your job, then you can use one of those online tax filing softwares. They're very cheap to use, and a lot of times they might even be free, and they will walk you through all the different deductions and exemptions and credits that you can get. That way you can pay the least amount of money in taxes. So if you have just a simple tax return where you're just making money from your job, then use one of those online things, because that's going to be the most cost-effective ways to go. If you get a little bit more sophisticated, like now you're investing in real estate or you have other businesses that you're a part of, that's when you really want to start looking about getting your own accountant, because an accountant's job is now to manage your bookkeeping and check the numbers and see how the numbers are going, and then find you the most deductions that you can get. That way you can pay the least amount of money in taxes. When I was in law school, I spent a lot of time and I took a lot of classes on taxes. The tax code is thousands of pages long. It is not worth your time to try to find every single deduction. Hire a professional. That way you can save the most money on taxes, and that way you don't have to deal with the headache. Now, if you get to this point and you ask yourself, wow, if only there was a way to fast track my way to wealth, well, there is. Once you know how to use your money, which is all the things that we just talked about, then you can fuel the system by adding more money into the system by earning more money. The simplest way to make an extra $5,000 to $10,000 a year is just by asking your boss for a raise. So if you think you've been doing a good job and you've been working at your place for a while, then you can go to your boss and demonstrate the value that you provide and show how you're going to make the company more money and show how you can take on more responsibility, and in exchange you can ask for a raise. That way you can make more money. For some of you, that's not going to be an option because you can't stand your job or you don't want to put any more effort into your job or whatever, so you might want to consider getting a side hustle. So there's a lot of different ways you can do this. If you are really a big fan of the internet, you can become a virtual assistant, you can be a freelancer, you can do design work. There's a lot of things that you can do on the internet to make extra cash, either by doing something, creating something yourself, or by creating services and offering these services to other businesses that need them. The advantage with this is you can do these side hustles usually on your own schedule and on your own time and wherever you want. But the downfall is it takes more effort to get started. Like if you get this raise, then you just keep doing what you're doing and you're already making this more money. With a side hustle, you have to go out and really earn this money, so it can take you weeks or months or maybe even a year to start making money, depending on your effort and depending on how good you are at what you do. And if that's not good enough, then you can go out and you can consider starting your own business, or you can consider investing in somebody who's starting a business. So starting a business obviously has the most risk because the majority of small businesses fail. I can tell you from first-hand experience that starting a business is hard work and you're not going to see the returns that you want immediately. It takes years to really get any return out of starting your own business, if you get any return. But if you feel like you have the entrepreneurship bug and you really want to be a business owner, then this is an option for you, and you really just got to go out there and start, and this can give you the opportunity to earn more money, but is not guaranteed. And finally, number 10, check yourself. Kind of like what we hinted at in the beginning of this video, where you took out a piece of paper and you looked at how much money you had coming in and you looked at where all the money was going out. You need to make sure you keep doing that every single month because you want to make sure that your money is staying on track. This is not something that you can just do once and then hope for the best. Being wealthy and building a financially healthy lifestyle is a lifestyle. It's something that you have to do forever. Every single month, pull out a piece of paper, look at how much money you had coming in, look at how much money you had going out, and compare it to your goals. When something goes out of whack in your finances, it can mess everything up. Like in 2019, Americans paid something like $11 billion in overdraft fees. That's money that Americans didn't have because they spent money when they had no more money in their bank account. You need to be the CFO, the Chief Financial Officer of your finances. So see how much money came in and see how much money came out and make sure everything is adding up. School doesn't teach you to be rich. School teaches you to be an employee. If you want to be rich, you have to understand money. If you want to be an employee, you have to know how to work. The problem is when you spend all your time working, you'll never have any time left over to make any money. Let me explain what I mean. If you think of some of the wealthiest people in the world today, they didn't just get there by working and getting a paycheck for the hours that they work. They did something different. They took a risk. And this is one of the concepts that school never teaches us, but it is the backbone of building wealth in this country, and I had to learn this the hard way. It is the backbone of how you can become successful in this economic system. We live in a capitalist system. You can hate it, you can love it. The reality is, this is what the system is. I wish my teachers or somebody would have told this to me and explained this to me instead of saying that the capitalist system is the greatest system in the world or saying that it's the worst thing in the world. Like, that doesn't do any good. Explain how it works. That way you understand how the system works. That way you understand how you can win in a capitalist system. In a capitalist system, the risk takers who win get rewarded. Let me explain that because I'm a football guy. When you play football, you don't get an abnormal amount of benefit for an abnormal amount of risk. What does that mean? If you have the football and you're throwing Hail Marys all the time, well, the most amount of points that you can make if you get a touchdown is 6. If you throw a Hail Mary, you get a touchdown, you get 6 points. If you do another Hail Mary, you get a touchdown, you get 6 points. There's no difference between doing a Hail Mary and getting a touchdown and doing a bunch of slow running games, a bunch of slow and short passes, and working your way down the field. There's no difference. It's 6 points if you get a running touchdown. It's 6 points if you get a Hail Mary touchdown. In this capitalist system, the one that America is in right now, that's not how it works. If you take a big risk, there's no limit to how much you can make. You can 1x, 2x, 100x, a millionx your money and your return, meaning there's no limit to how much money you can make, and the more risk you take, the more calculated risk you take, the more money that you can make. But if you don't take any risk, you never have the opportunity to get any of that upside. So why do some people become insanely wealthy? Well, most people don't. is because some people understood how the system works, they took that risk, and they were able to win in that risk. Now, of course, some people get this money handed to them, some people get this money passed down to them, some people win the lottery. I'm not talking about those people. Those are the outliers, they're not the rule. When you go to your job, when you go to work, you're guaranteed a paycheck. If you go to work, you put in the time, you put in the hours, you will get paid a check. There's no risk there. There's a little bit of risk that your company could go bankrupt, your company could go under, and maybe they can't make a payroll or maybe 2 payrolls, but your risk is very minimal. The biggest that you can lose is that you can lose your job. But now when you are the business owner, if you're starting a business, the risk is very different because maybe you have a product where you need to sell a widget. You got to sell something. And it takes you 3 employees in order to build this business. One person's got to make it, one person's got to market it, and one person's got to handle all of your fulfillment and inventory. You have 3 people that are needed in order to build the business, and each person costs $50,000 a year in salary. Now you have to front the salary in order to do that, or you have to find a way in order to fund that. So you got to pay $50,000 to employee 1, $50,000 to employee 2, $50,000 to employee 3, and now you have to hope that you can make enough money to pay the employees. Maybe for the first 6 months you're not making enough money. Maybe you have to pay out of your own pocket. Maybe you have to go and get a loan. Maybe you have to go and raise money from investors and take that risk in order to be able to pay these employees. But then maybe 6 months go by and then you start to break even. You haven't made $1 yet, but your employees who are coming to work every single day are getting paid. They're coming into work and they're putting in the hours and they're getting paid. They're taking a risk that they're hoping that their company doesn't go under, but your risk is now you have a loan that you're personally liable for. So if you don't pay the money back, they might take your car away from you, or they might take other things away from you. You have investors that are relying on you, and so if you don't pay them back, they're gonna be upset. They might come after some other stuff depending on what your arrangement with the investor is, or you invested your own money. And so if you don't make your money back, well, that's your own money that's lost. You just lost $150,000 because you had to pay these 3 employees for the year. But maybe month 6 happens and now you start to break even. Now you can make your debt payments, you can make your investment payments, and you're able to pay the employees. You're still not making any money, but your employees are making money. Now another 12 months go by, and now you're not making $50,000 a year, you're not making $100,000 a year, but you're making $5 million a year. And let's assume that your costs have not gone up. You still have the same 3 employees as before. Each of these employees are making $50,000 a year, but now you're making $5 million a year as a company. Yeah, you might want to reward your employees. You might want to give them a raise. Maybe you give them a profit share bonus. Maybe you give them some sort of revenue share bonus. That's up to you. But all that other upside, all those other millions of dollars are now yours because you were the one that took the risk to start this business idea. In this economic system, if you take the risk, you get the reward. Now, maybe you don't like that. Maybe you get angry and you want to fight about it, but this is where you got to understand. Do you want to be right? Or do you want to be rich? If you want to be right and you want to argue about it, that's fine. That's completely up to you. It's a free country. Or you can understand it and you can work to be rich and learn how the system works. Because the reality is this is how the system works. It's happening around us right now. But you got to also understand that this risk and reward can also work in the opposite direction. Let's assume that now instead of starting a business where you're selling a product, you're investing in real estate. And so now you're working to buy rental properties and you built up a portfolio and things are going well because property prices are going up, rental prices are going up. You're making so much money, things are going great. But then something like 2008 happens, where now home prices are going down, tenants can't pay. Well, a tenant doesn't have that much risk. They're in a contract to pay their lease, but the most that they can lose is whatever's in that contract, and usually they can walk away and just lose their security deposit. So you really don't have that much at risk when you're a tenant. But you as the landlord, as the investor, as the owner, now you're taking on all the risk. And so if your tenant leaves and property prices fall, now maybe you go underwater on your properties and you can't refinance. And if you can't find another tenant who's willing to pay, now you're stuck. Maybe you have to cut your rent prices. Now, if you cut your rent prices, maybe you lose out on all of your profits. Maybe you were relying on your real estate business in order to pay for your lifestyle, but now you have no income coming in because all of your money is going to pay off all your expenses. And if the economy continues to go down, and now you have this real estate business that you're relying on, and now tenants aren't paying. Tenants are damaging your property because they're angry, they're upset with what's going on in the economy, they damage your property, and now you have these broken properties, and you have to keep lowering your rents that now you're not making money. In fact, you're not even making enough money to make your payments. You can't even pay your contractors, and now you're underwater, and you have no money coming in anymore to pay for your lifestyle because now your real estate was funding your life. Now, not only do you not have money to pay for your lifestyle, to pay for your expenses, but you don't have money to pay back your mortgage lender for all of your properties, and that's when they come in and they foreclose on you. Now, your credit score is getting hit. The bank might put a multi-million-dollar lien on you. The contractors might be suing you for this back money that you owe them, and now you're dealing with all the stress while you have no money coming in, and now you have to go and figure it out. So you have risk, which is now you investing in real estate. You have the risk of the downside. It's the same thing in business. It doesn't matter when you have risk. You have risk of the downside. But the benefit is when things work in the upside, you get to reap the rewards of that. This is how the system works. The nice thing about being alive in this day and age is that you can take advantage of a lot of the upside without taking on all of the downside risk. How? Well, there are so many different investment platforms out there right now which will let you invest your money without worrying about having to lose your home or lose your car. That you can invest your money in the stock market and now your risks are limited. Where now the most you can lose is the money that you invest. And investing in the stock market is very accessible today, where 10, 20, 30, 40, 50 years ago, it wasn't so accessible. Because now if you want to invest in the stock market, there are so many free brokerages out there that you can open up on your phone. Back 10 years ago, there were no free brokerages out there. You had to pay a commission, so it was much harder to do that. Now you can start investing with $1. Same with real estate. There are crowdfunding platforms that will let you invest in real estate, get exposure to real estate with as little as $1,000 or $100, some even $10 nowadays. Now the nice thing is you get to get some of the upside, where now you can get some dividends, you can get some appreciation, but the most that you can lose is the amount of money that you have to put in, and you don't have to deal with any of the headaches. When a tenant destroys your property, when someone sues the real estate owner, you're not the one dealing with that, you're just investing your cash. You can also invest in startups now, where now you can invest in companies that you like, that are innovative, for less than $100. There are so many crowdfunding platforms out there right now. One of them is Republic, one of them is Start Engine, one of them is WeFunder. I'm not paid by any of these companies. These are just some of the platforms out there that allow you to invest in startups. Yes, it's very risky because most startups will fail, but you also have the potential for a lot of return. So this is that abnormal return versus risk benefit that you can understand, where in this system, the risk takers are the ones that are benefited. We are never taught this, but this is the reality of how the system works. This is what's happening around us right now. And you can either spend your efforts trying to be right, fighting the system, or you can get rich, understanding the system, and then taking better care of yourself, your family, and your community. But this is where we come back to the whole concept of equity, which is how wealth is built in America. In America, wealth is built not through your salary, but through equity. In this capitalist society, there are two ways that you can earn money. You can earn money from your labor, or you can earn money from your capital. Your labor is your salary. This is your paycheck. You're going to work, you get paid. Very little risk. On the other side, with your capital, this is much riskier. You're investing your own money. Either you're building equity or you're buying equity. Building equity is going out and starting to invest in real estate yourself, is going out and building a business. This is the most risky, but also has some of the biggest returns. On the flip side, instead of building the equity, you can just buy the equity. This is investing your money. This is investing your money into stocks, investing your money into the real estate crowdfunding platforms, investing your money into the startups, because now your risk is so much less. The most that you can lose is how much money you put in. There's no limit to how much money you can make, but you're going to be limited in the sense that if you went out and actually built the equity yourself, if you were building the company, if you were the one that was actually owning the real estate, you would get more upside. But there's still no limit to how much you can earn, because if you invest in a company on the stock market and they're tenfold, no one's stopping you from getting those gains. And this is where you want to be able to understand the system and how the system works. That way you can use the system for your advantage. See, we're taught to go to school, to get a degree, to get a job. And when you go to school to get a degree, to get a job, you're getting a salary. And that's nice as a way to start earning a paycheck, but a salary is never going to make you wealthy. Wealth is not built through your salary. Wealth is built through equity. So what we should really be taught is go to school if you want to get a job, fine, but working to build equity. The whole system revolves around building wealth through equity. So what we should be learning is, okay, here's a class on how do you become wealthy. It's through building equity. How do you build equity? You can buy it, you can build it. And the whole system is revolved around building this type of equity, and that's where real wealth is built. The last thing that I want to mention about this is the whole idea of getting rich quick, because there's this whole movement or industry on the internet where people show off, I'm 25 years old, I'm 35 years old, and I have millions and millions of dollars, and it was so easy. I did it in 6 months. the reality is for 99.9% of us, it's not that easy. It takes a ton of work. We don't get rich parents who are just going to give us millions of dollars. We don't win the lottery. We don't find this magic idea that's going to magically make us millions of dollars in 6 months. For the majority of people, the way that real wealth is built, I'm talking about real sustainable wealth, not some accidental I threw my money into a meme stock and I turned into a millionaire overnight. The real sustainable long-term wealth is built through long-term investing for regular people. Not everybody is meant to be an entrepreneur. Okay, entrepreneurship is hard. It is very difficult. It takes a lot of stress. It takes a whole lot of different types of way of thinking. Not everybody's meant to be a real estate investor. It's got its own headaches. It's got its own stuff. And so if you're not meant to be a real estate investor, that's okay. If you're not meant to be an entrepreneur, that's okay. You can still be a business owner without actually running and operating the business. How? By owning it through your capital. Taking some of the income that you're making and instead of spending it all, putting it to work. Investing this money, whether it's into the stock market, whether it's into real estate funds, whether it's into actual real estate, whether it's into startups, whether it's into cryptocurrency, whether it's into whatever type of investment that you believe in, that you understand, where now you can put your money to work. That way you can build wealth. But if you want to really build wealth over the long term, for the majority of people, time has told us this, that the way it's done is through slow, long-term investing. Constantly investing a piece of your paycheck every time you get paid and slowly doing this week after week, month after month, year after year, letting your money grow, letting your money compound, and letting your money build you wealth over long term, because if you do this for long enough, you will be able to become very, very, very successful, but it requires you just to get started, and it does not matter how much money you're starting with, whether it's $100,000, $1,000, or $1. You need to get started, and then you got to keep learning. Keep investing in your own education. And thanks to YouTube, it's completely free to start doing that. And so then you can start learning from YouTube, then you can start reading books, and then maybe you can start taking classes if you find a class that's going to help you excel at whatever it is that you want to learn more about. But this is where you have to understand how the system works. That way you can capitalize on the system, but it requires you to actually understand the system instead of just complaining about it and hating the system. Being broke isn't fun, but it is cool. How many times have you heard somebody like your broke cousin Bunty say, "Bro, I can't believe how much money my credit card company's charging me." Now, if cousin Bunty was talking to me, I would say, "You might want to stop ordering the extra guac, bro." But that's not what the majority of people say. They say, "You think that's bad? Not only do I owe more money to Visa, but my student loans are the reason why I can't get a new Beamer." But here's the thing. If you keep doing what the majority of people do, you're going to end up like the majority of people. What does that mean? The majority of people are broke. The majority of people have little to no savings, and the majority of people have little to no investments. Jaspreet, why you gotta be so mean, man? We find comfort in misery, and many times it's easier to complain about being broke than it is to actually fix being broke. But if you never want to be broke again, there are some things that you need to start doing today, that way you never have to be broke another day in your life. Number one is stop feeling bad for being broke. Look, here's the reality. It's cool to be broke. In our society, people love talking about their problems. People love talking about their pain. People love talking about all the things that are wrong. And especially, they love talking about how broke they are, how they can't make any money, how they struggle becoming successful, and how rich people are evil. But if you want to become successful, if you don't want to be broke anymore, you got to stop talking like a broke person. It is very hard to become rich, but it's also very hard to be broke. So you got to pick your heart. And if you decide that you want to become successful, well, now you're going to have to start changing your lifestyle. You're going to have to change the way you act, which means you might also lose some friends, because people are going to think you're crazy for wanting to do things that they think are normal. What do you mean you don't want to go on that vacation anymore? I got more debt than you, and you make more money than I do. You will have to say no to some of the things that make you look cool today. That way you can actually be rich tomorrow. And most people are not going to understand why you're saying no to the vacation, why you're saying no to eating out, why you're saying no to a new car. These are things that you were always doing. Everybody always goes out and buys a new car. They finance it. Everybody knows how to go out and have a good time. Everybody knows how to go to Cancun and have a good vacation. Your focus should not be how do I look cool. Your focus should be how can I become wealthy. Number two is stop hating on what you want. Growing up, I always had this love-hate relationship with money. I always wanted money. That way I could take care of my parents. That way my parents didn't have to work as much, because my parents were fresh immigrants from a state in India called Punjab. So I saw them work their butts off 7 days a week. So I wanted money. That way I could take care of them. That way they didn't have to work as hard. That way we could have nicer things. Not that we were broke or poor or anything, but I just wanted to be able to give back to my parents. Secondly, I was always told not to worry about money. Don't talk about money. Money's bad. Money's taboo. And the people who have lots of money, well, they probably did something bad or evil. When in reality, if you want to become financially successful, it's not that you have to be a bad person. You just have to understand how money works. And so when you grow up with this whole idea of hating people who have money, how do you expect to have money yourself? And this is one of those things that never really clicked until I started to see the other side. But if you want to become financially successful, you can't hate on the person who has money. Instead, you got to ask, how did they do it? What did they do to achieve that money? And then do it for yourself. Number 3, you got to stop talking like a broke person. There are 3 phrases that I need you to stop saying today, because these 3 things that so many people are saying are keeping you broke. Number 1 is never say that I can't afford it again. Instead, I want you to say, how can I afford it? Number 2, I never want you to say it must be nice to be able to afford those types of things. Again, instead ask, I wonder how I can be able to afford these things. And number 3, never say that I will never be rich. Instead say, what do I got to do to be rich? I learned this particular lesson from Robert Kiyosaki, who's the author of Rich Dad, Poor Dad, because he talked about in his book how the words that you speak influence the way you think, and then the way you think is going to influence what you do. Because now if you tell yourself that I can't afford something, your brain shuts off. Your brain says, yeah, I can't afford to have nice things, so I don't have to think, how can I afford the nice things? But if you change the way you speak, it's going to change the way you think. If now you say, I wonder how I can afford it myself, now your brain stays on. And now you start thinking, what do I need to do to afford this $10,000 trip? How do I actually get this $10,000? And now you're going to change your actions. Maybe you start watching YouTube videos on how to earn more money. Maybe you start reading books on how to earn more money. Maybe you take a class on how to earn more money. Maybe you try to start a side hustle. Maybe you start a business. Maybe you work harder at your job. And now you're actually putting things into action on how to achieve that thing because you didn't shut your brain off. Broke people have a specific way of speaking because they're always turning themselves off. They're always talking about how they can't achieve something, and they're always talking about why they're not capable of doing something themselves. But like Steve Jobs said, those who are crazy enough to believe they can are the ones that do. And the reason why is because if you believe you can do something, you're going to put in the work to figure out how you can do it. So if you want to stop being broke, you got to stop talking like broke people. Number 4, you have to create a financial system with your money. This is how financial planning looks in the majority of households in America. You go to work and you get paid, you make money. Then the next thing that you do is you pay taxes, and then you spend money, and then you wonder where all your money went. This is why so many people are broke, because they have no plan on what to do with their money. But what every single wealthy person does is they have a plan for their money before they earn it. That way every dollar that they earn has a job. So it looks something like this. You make money, and if you do it correctly, you can pay way less money in taxes. So we'll put taxes here, but we'll put less taxes. And then they create a system where now before you go out and spend money, you're first investing money. Because this is how wealthy people become wealthy. They own assets. Assets are things that you buy for the sole purpose of making money. So you make money, then you buy this thing, which makes you even more money. And then they might save a little bit of money. Now, wealthy people aren't saving all of the money because their savings are losing value to inflation every single day. However, you want to have some savings to protect you against an emergency, because in case you lose your job, in case something bad happens, you want to make sure you have some cash to fall back on because you never want to go into credit card debt. Wealthy people are always planning for worst case scenario types of situations. That way they don't have to worry about taking 10 steps back when something bad happens. So they plan for that. And then that's when they spend whatever's left. Now you might hear this and say, but Jaspreet, how in the world am I going to do that? Because I'm already struggling to pay my bills as it is. I'm living paycheck to paycheck. I barely have any extra money to do anything else. How do you expect me to invest first, then save, then spend? Well, this is where you have to create a system for every dollar that you earn and know how to live within your means, and then work to increase your income. Let me show you what I mean. The way I like to think of it is that as soon as you make money from here on out, it's going to flow through a 3-headed funnel. So you're going to go to work, you're going to have your business, you're going to earn some money, and then when you earn money, it's going to flow through this funnel where 75 cents is the maximum of every dollar that you earn, which you can spend. 15 cents is the minimum you invest, and 10 cents is the minimum that you save. This is a 75-15-10 plan. You can rearrange this based off of your own financial situation, but this is where you want to be ideally, where you're investing a minimum of 15 cents of every dollar that you earn. Now, if you can invest more, even better, because this is where the real wealth is built, because now your investments will be paying you without you having to work. This money that you're working to earn, when you go to work, when you run your business, when you're working to get paid, well, there's always a limit to how much you can earn. Now, sure, you can build a business that's scalable. However, there's a limit to how much you can work. And you always want to make sure you have some assets that will pay you without you working. So if you're building a business, you want to make sure that you can build a business that doesn't need you in there. You want to see how you can scale the business, that we can hire somebody to run the company. But if you're working a job, well, if you don't go to work, you're not getting paid. So you have to create a system where you can get paid without you working. People talk about how to get paid while you sleep. This is what it's all about. You have to own these assets. Now, you can pay tens of thousands of dollars to learn how to do this, to understand the nitty-gritty, but at its very core, the reality, if you want to become successful, you have to spend less than what you earn, then you have to invest the difference. Where do you invest it? Well, you can put this money in the stock market. You can use this to buy rental properties, real estate. You can use this money to go invest in other businesses. You can invest in startups. You can buy a franchise. There are so many different options of the ways that you can invest your money. Some of them are going to be way riskier than others. But the whole idea here is you're going to put your money to work. That way you can earn more money. Now, when you are investing your money, one of the things that can help you make smarter decisions is being aware of what's happening in the financial markets. And this is where you want to be educated about what's happening in the world financially. And if you're looking for an easy way to do that, well, I created a tool called Market Briefs. It's completely free. And the way the Market Briefs works is it's a daily newsletter where every day my team is working to break down what's happening in things like the economy, the stock market, the real estate market, crypto, and the global economy into a fun, witty, and easy to read email. Even if you don't have a financial background, not only are you going to understand what's happening in the financial markets, but you're actually going to look forward to reading Market Briefs every morning, because we make it so much fun and we make it so engaging. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs for free down in the description below. You also want to save your money strategically, because if you grew up like me, where my parents always told me that I need to work hard to earn a big salary. Why? So I could save a lot of money. I didn't grow up learning about investing. I never knew what the term investing was. I never heard about passive income or dividends. These were things that I had to learn on my own, because I didn't grow up with any sort of financial education. But my parents did stress the idea of saving, which made it very easy for me to live below my means. But saving your money just to save it is not a plan to become wealthy, because you can never save your way to wealth. Wealthy people become wealthy by investing their money. They don't become wealthy by saving their money. Your savings are not there to make you wealthy, but your savings are there to protect you against a financial emergency. So this is where you want to save strategically. You want to save somewhere between 3 to 12 months worth of your expenses. So figure out how much your monthly expenses are, multiply it by 3, and then multiply it by 12. And that's the range of cash that you want to have saved in a bank account that's easy to access. So in case you lose your job, in case something happens to your income, you have cash to fall back on, and you won't have to worry about going into debt to continue feeding your family. It is your duty to make sure that you can take care of yourself, your family, and your community. And this is where I don't want you to blame other people. Don't blame your boss. Don't blame the government. Don't blame other people. You want to be the one that's in charge, because you want to be held responsible, because you can take better care of yourself and your family and your community than anybody else can. So this is why it's important for you to take care of yourself, and that includes financially. So create some savings, but don't just save all of your money. Now, once you hit your savings goal, what you can do with the extra cash is now put this money into your investments. This is where things really get fun, because again, your investments are there to make you more money. So now you're working a job to earn money, and then your investments are making you more money, and then you have more money going towards your investments, which make you more money. So now you're making money from your job, and your investments are also making you more money, which are working to make you more money. So it starts to create this positive cycle, and it doesn't happen overnight. It doesn't happen in 6 months. But if you stick with this, well, in 5 years, 7 years, 10 years, you start to build this machine where all of a sudden you were working hard to put a little bit of cash aside, and you saw no returns for the first few years, but now you're starting to see the big paydays. You're starting to see the bigger returns. You're starting to see the bigger dividends because of all the years that you put in. But it requires you to get started, and it requires you to stay consistent. And the fifth thing that you got to do now is you got to start earning more money. This is the final piece of the financial puzzle where now you built the system. You have the right mindset. You understand how to not think and talk like a broke person. But now, what do you want to do? Well, you have the system, but now you got to fuel the system. How can you get more dollars flowing through here? Yeah, you can invest more money, but how are you going to get more cash to invest even more aggressively to get you to your financial goals sooner? You're going to have to earn more money, because if you earn more money, now you're going to have more money going here. Before, if you earn more money, what would happen? Well, for the majority of people, you would see a rise in your expenses. When the majority of people earn more money, they buy a nicer car, they buy a bigger home, they buy a boat, they go on a vacation, they spend money on dumb things. Now, there's nothing wrong with having nice things. Let me just put this out there. I want you to have all the nice things. I want you to have the luxury car. I want you to have the nice vacations. I want you to be able to eat out. I want you to have all the nice, expensive luxury things. But I want you to be able to afford it first. That's the key. There's nothing wrong with having nice things. There's nothing wrong with buying dumb things. Buy all the dumb things that you want, but just make sure you can afford the dumb things that you're buying. And how do you do that? Well, first, you gotta have the assets. You gotta have the investments. So now, how do you afford more dumb things? Well, you gotta have more money coming in, because when you make more money, you have more money to spend, more money to invest, and more money to save. For the majority of people, before they have any sort of financial system, they make more money and then they spend more money, and then they still wonder, where did all my money go? Where did my bonus go? Where did my raise go? So this is where you gotta have the system. Now, how do you earn more money? And this really is just gonna depend on you. For me, I'm an entrepreneur. I never worked a traditional job. I'm a licensed attorney. I went through law school, but I never worked a day as an attorney because that wasn't appealing to me. It wasn't attractive to me. And if you like the idea of working a job, that's fine. There's nothing wrong with that. But now, figure out if your job, your current job, is gonna have the ability to give you more money. If not, how can you get a certificate? How can you move to a different career? How can you get a job that will give you the lifestyle that will fund your financial dreams? If you want to do something outside of a job, how can you create a side hustle? How can you start a business? Building a business is hard, but it's very fulfilling. And this is where you have to understand, do you have the work ethic? Do you have the discipline? Do you have the risk tolerance? And do you have the mental capacity to start a business? Because when you start a business, people are going to talk about you, especially in the beginning. Everyone's going to talk crap about how you have this dumb business idea. You don't understand why you're working on it. You could be working on your career. You could be working on so many other real things that could give real benefit to your life, but you're blowing your money, you're blowing your time, and you're risking your family's future on this dumb idea that you have. But if you make it, then everybody's gonna talk about how they supported you, how they're so happy that you became successful, and they're gonna say all this stuff, but you have to be willing to withstand all that crap until you get there. Now, it's not easy to get there because most businesses will fail. However, if you have the entrepreneurial bug, where you're always thinking of business ideas, where you're always looking for ways to earn more money, where you're always looking for extra opportunities, where you don't mind working hard, where you don't mind working on weekends, well, then maybe you want to go out and try starting a business. And this doesn't mean you have to go and quit your job, but maybe you can start doing something in the evenings and the weekends. And how do you start? Well, start by watching YouTube, start reading books, start taking classes, start doing things, and start screwing up. The more you fail, the more success that you will see. Making $10,000 a month is validation that the idea that you had has merit. But how do you go from $0 to $10,000 a month? Well, let's start by working backwards. If you have a product or service that makes you $10 per sale, you would have to sell 1,000 of these a month. If you make $100 per sale, you're gonna have to sell 100 of these a month. And if you can make $1,000 from each product sale or service sale that you make, you would have to sell 10 of these a month. But if you are in the content business, you make YouTube videos, you make podcasts, and let's assume that you can make 1 penny for every view or download, which is pretty reasonable, especially on YouTube, then you would have to make about 1 million views per month to hit that $10,000 a month goal. And if you have investments where you can get a 7% cash on cash return, this is cash flow, whether it be through dividends or whether it be through your real estate investments, you would have to invest $1.7 million to get this passive 7% return on your money to get you the $10,000 a month. Now you can just pick your option and work backwards. I'm assuming that most people don't have $1.7 million to invest to get the 7% ROI. So now we look at the other options. Is it going to be building content online, or are you going to be selling a product, and what's the price of the product, and how many of these products do you have to sell? If you want to create your own income but you don't have a lot of money to start, there are 3 different options that you have. Number 1 is you can go out and try to raise money from investors, but then your investors are going to take a piece of ownership from your company. Option number 2 is you can try to go out and raise money from a bank through debt. But then that has its own risks because you have to pay this money back, you have to make your monthly payments, and if you don't, then the bank can take over your business. And option number 3 is you can follow the 3-step bootstrap process. Earn, learn, and churn. First, you got to earn. Take what you know or take what you do and make some money from it. Second, you got to learn. Take the money that you just earned and use this money to learn a skill that's going to pay you with more money. And third, you got to churn. Once you learn more ways on how to earn more money, either you can double down into how you're earning money right now, or you can pivot and change how you're earning money. That way you have a more scalable income. When I started this YouTube channel, I was very comfortable financially. I was already running some businesses. They weren't huge successes, but they were pretty decent, and they allowed me to start investing in real estate, because what I was doing was I was making money from these businesses and buying as much real estate as possible. So I was working to build up my rental portfolio, and then I started making YouTube videos. At first it was just a hobby. I started making YouTube videos because this was a way for me to talk about the things that I wish I had learned when I was getting started. I didn't know that I could make money from YouTube when I started making videos. I really just started this because I got scammed and screwed over at one of the companies that I was working on and running, and so I was so frustrated. So I started making videos on how to launch a business without getting screwed over. Then that kind of transformed to more financial education. It kind of transformed to money management, investing, entrepreneurship, the broad financial education stuff. But for me, this was a hobby because I was busy doing the other things that I was working on. But then as the YouTube channel started to grow, we started making some money here on YouTube, and then I started pivoting more time here on YouTube. And then I wanted to create a real company, something more involved in the financial space, because I'm much more passionate here. And that's when I had the idea to create Briefs Media, which is my newsletter company. I didn't grow up learning about business or entrepreneurship, so the experience that I got was from the things that I did and from what I read in books. And in the beginning, I assumed that business meant that a business would rely on me. I would have to do everything. If it wasn't me doing everything, then I wouldn't be getting paid. I assumed that was the only way that you could do it. But then through books, I started learning more about this idea of scalable businesses, where a business doesn't have to rely on you as the founder, where you can build a team and you can essentially plug yourself out. So I started learning this and realized this is something that I want. I want to build something that's more scalable, that's bigger than just me. That was what Briefs Media wanted to do, but the problem was I'm not a very good writer. I don't want to be the one that's writing all the newsletters. I need to build something that's different than me. Now, how do I do that? Well, I need a staff. I need people that would write the newsletters. I need people that can do the research. I need a business development team that can get advertisers to pay money to actually be sponsors on a newsletter. Well, it costs money to do that. And so if I wanted to do that, I would need money to go out and do this, but how am I going to do that? Well, that's when I started taking the money that I was making from here on YouTube, and instead of going out and buying nice cars or even buying real estate, I took the money from YouTube and then I started hiring staff. I started building more teams, started building more systems, and I started investing into this newsletter. Now, it's risky, because there's a chance that this whole business can fail. We can go bankrupt and I lose everything with nothing. With real estate, if I invest my money into a property and something bad happens, I still own the land. I still own the building. I have something that I can sell. With your own business, you don't have that. So you have higher risk and also higher potential reward. But for me, that was something that I wanted to build. So I kept learning while I was earning. I was earning here while learning and then taking the money and putting it back into Briefs Media. And now we started building the team, started building the systems, and now we've been able to scale this into a much bigger financial media company where we have a daily newsletter and multiple different newsletters that are going out to help investors, that are helping entrepreneurs, that are helping people in other countries learn about what's happening in terms of financial education. First, you gotta find the simplest and easiest way to start earning money. Once you can start earning money, then you reinvest these earnings into learning. As you start learning, now you're gonna change what you do. You gotta start churning to find something that's more scalable that can allow you to scale your income. Because you can start earning your way to $10,000 a month. That's very possible. But if you wanna scale it from 10,000 to 100,000 to 200,000, you can't do it all by yourself, which is why you have to understand the churn as well. The best decision that I made was the first time I started making $10,000 a month. This is before my time on YouTube, but the first time I started making $10,000 a month, I did not go out and buy a new BMW like I wanted to do. As soon as I started making more money, the first thing I did was I went onto Google and I started looking at the newest BMW 3 Series. There was no BMW 4 Series then. I was looking at the 3 Series and I was telling everybody how I was going to go buy this new BMW 3 Series, but instead of doing that, I ended up going and buying more real estate. Everybody that I knew was making less money than me. But everybody that I knew also had a nicer car than me. Everybody that I knew was going on more vacations than me. Everybody that I knew was eating at nicer restaurants than me. And everybody that I knew was blowing way more money than I was. I was making good money. But I took all this money and I was only buying real estate. And it was where I was learning. I was buying real estate and I was reading books. I was buying real estate and I was taking classes. I was buying real estate and I was investing back into me because I knew that I wanted to build something more scalable. I just didn't know how to do it. Before I was on YouTube, I was doing a lot of different things, but for a period of time, I started investing in real estate and I realized I don't have enough money to keep buying more real estate. So I needed more income. So that's when I went out and I got my realtor's license. I became a real estate salesperson and I helped people buy and sell homes. And when I was doing that, I realized there's other ways that I can do more of what I'm doing right now and earn more money because my broker happened to be a teacher who taught real estate wholesaling. She invited me to a seminar that she was running on wholesaling real estate. I went to the seminar and then I paid another $3,500 or so to learn how to wholesale real estate. And then I took this knowledge that I had that I learned and I started wholesaling real estate and I started making pretty good money. It took me 4 months or so before I made my first sale, meaning for the first 4 months I was working my butt off and I made no money. And then on month 5 I closed my first sale and my second sale, and then I made a little bit over $10,000. Same with month 6 and on from there. And instead of taking this money and going out and blowing it because I started earning some money, I took this money and I reinvested it. And this time I used this money to start buying more real estate. But this is where understanding you got to earn some money, then you got to learn how to grow your income, and then you got to keep churning. You will make mistakes that lose money. We did that here, where when we were trying to invest in our Minority Mindset blog, I spent a lot of money trying to build it because I didn't have the time to manage it. I was working on a bunch of different projects and I wanted to build this blog as a cash generating tool on our website. And so I hired the best consultants, I hired the best team, I hired the best writers. And over 18 to 24 months, I probably spent about $500,000 to get this blog built. Well, guess what? That blog went nowhere. The $500,000 went down the drain. Sometimes you are going to lose. That's a part of entrepreneurship. But this is where understanding, sometimes you got to be willing to take the risk. You got to be willing to learn, and then you got to be willing to churn. And it all starts with having a way to earn money. There's an unlimited ways that you can earn money. Go out and start mowing people's lawns. Go and shovel people's snow. Go and rake people's leaves. If you don't want to do that, then go and sell some services online. Go and learn how to do digital marketing. Learn how to do video editing. Learn how to do graphic design. Learn how to do copywriting. Then read books. Read books on how to start a business. Read books on how to scale a business. Read books on how to manage a business. Read books on marketing. Start learning and absorbing the content and get fully immersed into this idea that you want to create something that can create an income. And you got to keep being willing to start over and do it and be fully committed to what you're doing. And it's going to sound weird. What do you mean start over and be fully committed? Be fully committed to the idea that you want to succeed with it, and understand sometimes you got to be willing to cut the losses, but you don't want to just cut the losses every time you don't see the success that you want in 6 months. Be fully committed to learning, and as you learn, you're going to learn more about scalability. You're going to learn more about growth. You're going to learn more about marketing, and that's going to allow you to scale your income to something a whole lot bigger. First, there's no financial education when we're growing up and going to school. Now, this one is particularly close to my heart because I always wanted to be successful. My parents are immigrants that came to this country with not that much, and I always saw how hard my parents worked. So growing up, I wanted to become successful so I can give back to my parents and give them things that they never had. So I assumed that the way that you become successful is by studying hard in school, by getting good grades, that we can get a good job. In my house, that meant that I needed to go out and become a doctor. You know, your typical Indian stereotype. Along the way, I realized that I didn't want to be a doctor. I wanted to be an entrepreneur and I wanted to be an investor, but my parents didn't really like that, so they compromised. They said if you're not going to be a doctor, you have to at least be an attorney. So I went through college, I went through law school, and I went through all the schooling to learn how to become successful, but never once did I learn about money. I never learned about how to manage my money, I never learned about how to invest my money, and I never learned how to build wealth in the economic system that we have right now. The first bit of financial education that every single person needs to understand, especially if you live in America, is that there are two different ways that you can make money. You can make money from your labor, and then you can make money from your capital. You have to understand this if you want to be able to build wealth, because our education system and our schooling teach us how to maximize the income that we make here from our labor. You go to school to get good grades, to get a good degree, that way you can get a good job. This is the money you make from your labor. You go to work to get paid. Now, the idea of you going to school is so you can get a high-paying job. You go and you become a doctor, you become an attorney, you become an accountant, you become an engineer. You're a high-paid worker, you're a high-paid employee. But in the economic system that we have right now, the highest paid people and the most financially successful people in the country are not high-paid workers. It's people that know how to deploy their capital. Let me show you what I mean. So this is what school teaches us how to maximize. This is our corporate ladder. You go from analyst to associate to VP to director to the CEO. You go to the C levels. So school wants us to climb the corporate ladder. But what people who understand the economic system understand is they don't want to just climb the corporate ladder. They want to own the corporate ladder. Remember, we live in a capitalist society. It says it in the name. Now, you can hate it or love it. The reality is we live in a capitalist society. In the name, it tells you that if you want to become successful, you have to deploy your capital. It's in the name. So the people who become insanely successful understand this, and they're working to grow this. They want to invest their capital because now it's your money working to increase value instead of just your labor. There's a limit to how much you can work. There's a limit to how much value you can provide directly from your labor alone, but there's no limit to what you can do with your capital. This is where a lot of people get upset because they say, I'm disadvantaged. I don't have rich parents. I wasn't born into a lot of money. So how am I supposed to take advantage of the system? Well, what you need to understand is you need to use your labor to generate capital. That way you can use and deploy this capital. That way you can become wealthy in this economic system. Most people, the majority of people, are working for a bigger salary. That's what they assume is going to make them wealthy. But that's a lie. Our economic system has it in its name, capitalist. The way you become wealthy is by using your capital. That way you can earn a piece of profits. See, let me explain this because it took me a long time to understand how this truly worked. I had to read a lot of books, I had to talk to a lot of people, and I had to experience it myself because this is something I never grew up learning. When you work a job, you're getting paid for the labor that you put in. Now, you could be a high-paid person, you could be a low-paid person, it doesn't matter. At the end of the day, it's the same thing. You're working for the owner of the company. You can get paid a lot of money as an employee. Doctors make a lot of money, you have executives that make a lot of money, but at the end of the day, you're still working for the owner of the company. Now, there's a difference between the salary, the income you make, and the profit that a company generates. The profit is separate from your income. Now, what these people here, the investors, the people who deploy the capital are working for is not an income, it's not a salary, it's profit. They're working for a piece of the profit. So I'll give you an example. Let's assume that I go out and I start a company, and my company makes $1 million in revenue. So I sell, for some fun, I sell avocados. I sell guacamole, okay? I make $1 million in revenue from my guacamole company, but I don't get to keep all the money in profit. I have expenses to pay. Maybe I have $100,000 in avocado costs. I have $200,000 in employee costs, and then I have another, say, $200,000 in other expenses. So I have to pay my CEO, I have to pay the people that mash the avocados, I have to pay for the salt, the pepper, and everything else. This all adds up to $500,000 in expenses. Now, I have to pay the team in order to run the company, right? Got to pay my CEO, got to pay the people that work in the actual avocado to guacamole making business. That's my cost. You're getting paid for your labor. And if you're really good at making avocados into guacamole, you're going to get paid more money. But once all the expenses are paid, there's another $500,000 in the bank account. The person who gets this is the owner of the company, because now you own the equity. Now, you do have more and more companies nowadays that are distributing some of this ownership, the profit, to the employees. Like here at my minority mindset companies, like at Market Briefs, we do a revenue share system where the employees get to share in the profits. But if you don't have that, what you need to understand is this is what wealthy people are working for. They're not working just to grow this by 5% or 6%. They want to see how can we drive more sales, that way we can get a bigger piece of ownership. And the way that you can do that is by working for this. This might mean investing in companies. It might mean investing in your own company if you have that sort of equity structure. It might mean investing in real estate or investing in startups. You want to use your money to buy assets, investments. That way you can build equity either in companies or real estate or some other sort of asset. That way now you can be the equity owner and get a share of this, because now when you're working for profits, now you have the team of people working to help grow the value in the company. Now, there's another debate that a lot of people talk about. This, how much money should an employee be earning? You have all the time people talking about minimum wage, how much money people should be earning more money. And that's fine, but what you need to understand now as a financially educated person is a concept called fiduciary duty. I learned this in law school, and it was a new concept that I didn't understand. Fiduciary duty is who you owe your alliance to, who you need to take care of first. An easy way to understand fiduciary duty is think of it like this. You have a date scheduled with your wife tonight, and then one of your friends calls you and asks if you can play video games with them tonight. You can't cancel on your wife to play video games with your friend because your fiduciary duty is to your wife first. Well, in this case, in this corporate ladder, the executive's corporate duty, the people who run the company, the executive's corporate duty is not to the employees, it's to the shareholders. It's to these people. So the number one goal of the people that's running the company is to drive this, the profit higher. It's not to pay the employees the maximum amount possible, it's to drive up the profit. Now, you have to understand, there's a moral aspect to this, there's a legal aspect to this, there's a financial aspect to this. You want to make sure that your employees are happy. You want to make sure your employees are well taken care of. That way they want to come to work every single day. That way they want to produce a good product. But if you are just working here, you're going to be constantly asking and wondering why you're not getting paid more money. But what you have to understand is the way the system works is designed to benefit this person. It's designed to benefit the person who's working for this, not just the person that's working for this. So you can do two things. Either you can go and work for a company that's going to treat you better, or you can work for earning more of this. That way you can deploy your capital. That way you can own equity in companies and real estate. That way you can build your wealth by understanding how the system works. This is why financial education is so important, and this is one thing that I wish schools would have taught me, and I wish schools would be teaching this to people nowadays so we can understand how to win in this system, because rich people and wealthy people understand this, but most of us are never taught this. The second thing that's keeping so many people poor is this overconsumption. That way we can look rich so people think that we're successful. Growing up, my parents worked their butt off. They were working around the clock, 7 days a week. And I remember when we used to go to family get-togethers, my parents would always tell me and my little brother that we need to wear a polo shirt. We had a few shirts that were nicer from the polo company that had that little horse on it. And they would always say, make sure that you can see the horse. Get a shirt that has the horse on it. That way people think that you're successful, and they know that you're successful because you have a polo shirt on. Now, I didn't really understand much about what was going on at the time, but I listened to what my mom said and I wore these polo shirts. Now, we were not broke by any means. Like, I never worried about where my next meal was going to come from. I was never worried about how we were going to pay for the bills, but my parents were still working their butt off. Like, they were working around the clock. My dad would barely even get holidays off, but the whole idea was at least you look like you're successful. Now, fast forward to today, I've achieved a much different level of success, and I don't remember the last time I bought something with that horse on it, the polo. I mean, I like some polo clothes. If I like something, I'll buy it, but I have no need or urgency to go out and buy this or to show it off. And I talked to my dad about this, and he does most of his shopping at Costco now, and he laughs about it because there's this whole idea of trying to look more successful than you actually are. And the number one reason why so many people are broke today is because you're spending all of your money trying to look rich. The first time I had more than $1,000 in my bank account, I was in high school from all these side gigs that I was running. And as soon as I had $1,000 in my bank account, I immediately went out and I bought the shiniest, most sparkliest watch that I could find. It was a $1,000 watch. I took all the money that I had and I went out and I bought this watch. It was covered in crystals. I still have that watch. I really need to bring it onto YouTube so you can see it. But I bought this stupid watch that way I would look rich, but in actuality, that watch was keeping me broke. This single mindset of trying to look rich before you're actually rich is what keeps so many people broke, because what happens is you make money and then you have to make sure that everybody else around you is rich before you are rich yourself. So as soon as you get paid, you make sure that Apple gets paid, you make sure that Lululemon gets paid, you make sure that Gucci gets paid, you make sure that Amazon gets paid, you make sure that everybody else gets paid, and then you're left with the scraps. Once you break out of that mindset, then it almost becomes a game of trying to figure out how you can stop spending so much money on things that you don't need. Third is a concept of overfinancing. So something that I like to say is that traditionally, Indian people make $1 to spend 20 cents, while American people make $1 to spend $2 thanks to the help of credit cards and lines of credit. Now, neither of these things are right or the best thing that you can do with your money, but what you need to understand is we live in a spending culture. Our culture is designed to make you spend money, which is why you need to have this financial education and understand how this works. That way you don't go into debt to buy a whole bunch of things that you don't need, because now you are a slave to your banks. You owe your banks money, and anytime you get paid, the first thing you do is you buy all the stuff that you don't need, and then you pay off your banks, and then whatever's left is what you use to build your wealth. And at that rate, you will never become wealthy, because all of your money is going out to make your banker rich, and it's going out to make Amazon, Lululemon, and Gucci rich. The simplest way for me to explain this is if it does not put any money in your pocket, you should not be financing it, period. If you don't have the money to buy it in full, in cash, you can't afford it yet. This includes doing 0% APR on your phone and financing your car. If you don't have the money to buy these things outright, you should not be going into debt to buy them, because these things are not going to make you any more money. Now, I understand you can use your phone in your business. I understand you can use your car to get to and from work. But if you don't have the money to afford it, don't go into debt to buy it. I get it. You need a phone for your business. Maybe go back a couple generations of iPhones. That way you can buy it for a few $100s instead of paying $1,000 that you finance over time. And even though it's 0% APR, there's a reason why 0% APR is so profitable for banks and companies. When you go out and you buy a bunch of things with 0% APR, you don't feel that pain of spending money, because $1,000 isn't leaving your account today. You're just putting it on a payment plan for the next 12 months, and then you can go out and buy even more things with the help of 0% APR. So now you're going out and buying a whole bunch of things that you wouldn't have otherwise, and now you're putting all these things on 0% APR, and then what happens for so many people is you don't pay off your items, you don't pay off your cell phone and everything else in time, so now you get slapped with an 18 to 25% APR interest rate. And now you're stuck back in the payments game, trying to pay off your banker, trying to pay off these companies. That way you can finally have some freedom back. Now, you can use debt to make you wealthier, but wealthy people are not going into debt to buy their cell phone. Wealthy people are not going into debt to buy a car that they can't actually afford. Wealthy people are using debt to make themselves wealthier by using this money to finance assets, which are making them money, instead of financing liabilities, which are losing them money. And this brings me to number 4. You're confusing assets for liabilities. And let me diagram this out for you. That way it's very easy to understand. An asset is something that puts money in your pocket. A liability, I'm just going to shorten that, is something that takes money out of your pocket. This part is pretty simple to understand, but what happens is many of us are confusing liabilities for assets. Let me give you an example of this. Your home is what everybody calls your biggest asset. That is where you will be able to build generational wealth. This is why we want to push home ownership for all Americans. Now listen, I'm a real estate investor. I have a real estate salesperson's license. I used to help people buy and sell homes, and I'm an attorney. I've seen this from a lot of different angles. And when I was getting my real estate license back when I was 20 years old, one of the first things they teach you when it comes time to selling real estate is how you are going to help so many people buy the biggest investment of their life, their home. We are bred to think that your home is an asset. We are bred to think that our home is an investment. But wealthy people don't look at the home that they live in as an asset. Wealthy people look at the home that they live in as a liability because it's not putting any money in your pocket every single month. Your home is a money pit. Now sure, maybe when you go and sell your home, you'll be able to sell it for a profit, but it's not guaranteed. We don't know when you're going to sell your home, and you only get that money when it comes time for you to sell your home. Up until then, your home is a money pit. Every single year, you got to pay your property taxes. Every single year, you got to pay for your maintenance. Every time you want to upgrade the kitchen or the bathroom or your kids' room, it's going to cost you money. You have to pay to fix the roof when the wind damages it, and you have to pay to fix that window when somebody throws a ball through it. But if I can sell you on this idea that your home is a big asset and it's going to be the biggest investment that you ever purchase, now what are you going to do? You're going to stretch yourself a little bit thinner, that way you can go out and buy a bigger home. Because now it's an asset. You're going to be able to give your kids this home one day. So now you go out and buy something a little bit bigger. Your debt payments are a little bit bigger, which means you have less money every single month to invest into assets. But at least you have a home. And now every single month, you're working to build equity in your home. You're working to pay off your property taxes. You're working to pay off your utilities. You're working to pay off the insurance. And then when it comes time for you to sell your home, hopefully you will have some equity in the deal. If it all works out, you will be able to sell your home for a profit, and now you'll be able to put some money in your pocket, but you're still going to need another place to live. But what you have to understand is, why did you buy that home in the first place? Did you buy that home to make money, or did you buy it to make memories? If you're buying a home to live in, you're buying it to make memories. You're not buying it to make money on. While wealthy people understand that the home that you live in is a place where you make memories. Sure, if you make some money on it, great. But that's not the reason why they're buying the home. They're buying the home to make memories. If I want to make money in real estate, I'm not going to go out and buy a big home to live in. I'm going to go out and buy a rental property, because my rental property I'm buying for the sole purpose of making money. If you really want to make money from a home, buy a home that you're going to rent out for somebody else instead of buying a big home for you to live in yourself. So what you have to understand is, your home is a liability more than it is an asset. It is a liability until you sell it, and if you sell it, hopefully you'll be able to sell it for a profit. But what happens to so many people is, we fall in love with the idea of owning a home, and then we want a really nice home, we want a bigger home, so now we stretch ourselves thinner and thinner and thinner, and now we're living paycheck to paycheck. That way we can just own a home, but hey, at least you're building some equity in your home, right? Well, if you weren't doing that, you lived smaller and you didn't think of your home as an asset, you didn't think of your home as the biggest investment that you'd ever make, well, now you'd have more money every single month to invest your money into assets, to invest your money to actually build equity into real estate investment properties, to build equity into companies that where now you can build real wealth, instead of just working your butt off to buy a big home, which is only really making your real estate broker, your mortgage broker, and your banker richer, while it's keeping you broke, because now you're having to work overtime just to make the mortgage payments. Remember, assets are things that you buy to make you money. Liabilities are things that take money away from you. Wealthy people put their emphasis here to own more assets and put less emphasis here. In fact, what wealthy people actually do is they put their emphasis here, that where their assets buy them their liabilities. They use their investments to pay for their expenses. And last but definitely not least is understanding this idea of our money. What are you working for? Most of the time we assume that our paper dollars is money, but the reality is our paper dollars don't store value very well. Think of it this way. You work hard at your job all year and you make $50,000. Now let's assume that you take this $50,000 that you earn and you print it in cash. Now you have this $50,000 in cash, and let's assume you could put it in a duffel bag, and now you have a time machine. So you go in this time machine, you take this $50,000 worth of cash, and now we go forward 30 years. What do you think is going to happen if we go forward 30 years with this $50,000? Do you think that $50,000 will be able to buy you the same things that you can today? No, probably not. Chances are in 30 years that $50,000 that you earn today is going to be able to buy you way less in the future than it can today, because of something called inflation. That's why the value of our dollars keep dropping and the prices of everything keep going up. But let's go backwards now. Let's assume that you have this $50,000 in cash, and we can go backwards in time. We'll go back 30 years. Now, do you think this $50,000 is going to be able to buy you the same things that it can today? No. If we go back 30 years, you're going to be able to buy way more stuff with that $50,000 than you can today, because $50,000 30 years ago had way more buying power than $50,000 does today. So now, if you're working for this money, this paper dollars, and you just keep stacking and saving this money because that's what we're told to do. At least that's what I was told, was I was supposed to work hard and then save as much money as possible. Well, this money that you're saving isn't growing because your bank isn't paying you any interest. It's actually losing value every single day. Your savings are losing value, effectively making you poorer each and every day just by saving your money, because inflation is way higher than what interest your bank is paying you. Money, at its core definition, is supposed to be some sort of store of value. So you earn $50,000 because of this labor that you put in, and the money that you have is supposed to store this $50,000. But our paper dollars don't do that. Our paper dollars are really just a means of exchange. It's a type of currency. It's a way for us to exchange our money. It's a way for us to buy things and do transactions with, but it's not a good way for you to store your money. That's why I call it fake money. What real money is a way for you to store the value of the earnings that you got. Traditionally, this would be something like physical gold, because gold is a store of value. It takes time, effort, and labor to mine an ounce of gold, and if you own some physical gold, you own a real representation or a real store of value. That's what gold is. We used to be on the gold standard here in the United States, meaning every dollar used to be a gold certificate. But we're no longer on the gold standard. In 1971, President Richard Nixon severed the dollar and the gold standard, which means you could no longer exchange $1 bill for a specific ounce of gold. Now, the dollar is separate from gold, which means that the government can print as much money as they want. The government can print as many dollars as they want, which effectively dilutes the value of each dollar, which makes the value of your money, your paper dollars that you're working so hard to earn, that you're working so hard to save, diluted each and every day. We just talked about the difference between a liability and an asset, but this is one of the reasons why it's so important for you to convert your dollars into assets, not just so you can become wealthy, not just so you can create cash flow, not just so you can take advantage of the system that we're in, but so you can actually preserve the value of your money. Because if you don't, your money is going to lose value each and every day in the bank, and this is what's happening to so many people. Inflation is known as a hidden tax. It's a tax on people that don't understand what inflation is. It's a tax on the financially uneducated, because as inflation continues to be very high, the value of your savings will continue to lose value each and every day, effectively making you poorer. So the people who pay this tax are the people that don't understand what inflation is. That's why it's a hidden tax. It's a silent tax. It's a tax on people who are financially uneducated. So if I haven't convinced you about the importance of investing your money because of the capitalist system that we're in, or if I haven't convinced you to invest your money, that way you can own assets instead of liabilities, or if I haven't convinced you to invest your money, that way you don't keep making every other company around you rich, hopefully this will be the reason why. Because if you don't invest that money, if you just own liabilities, if you just stack cash, well, that cash is gonna make you poorer each and every day, because the value of your dollars are dropping while the price of everything around you keeps getting more expensive, which is why if you want to at least preserve the value of your money, or if you want to grow the money you have, you need to own assets. That means owning shares of companies, stocks, or owning some physical real estate, actual assets, which will help to preserve, if not grow, the value of your wealth. Now, does this mean that every investment that you make is going to make you money? No, of course not. Investing has risks, but not investing has risks as well. Because if you don't invest your money, well, then your savings are going to continue to lose value to inflation each and every day. I recently put out a video about what you can do in your 30s if you don't have any investments to get started to become wealthy. And the number one type of comment that I got in that video is, what do I do if I'm in my 40s? Because guess what? If you're in your 40s, you don't have as much time as somebody in their 20s. Well, the good thing is there are three things that will determine how wealthy you'll become. Number one is the dollars. How much money do you invest? Number two is a return. How fast can you grow your money? And number three is time. How long do you have for your money to grow and compound? Well, the one factor that you cannot change is time. None of us can go back in time and start investing when we're 19 or 20 or 25 years old, but we can get started today. The thing that you have to remember is that you can make up for an imbalance in one of these three factors by putting more weight on one of the others. So if you have less time, you can increase how many dollars you're investing, or you can increase the return that you're getting. If you don't have enough dollars to invest, you can increase the type of return that you're getting. And that's what I'm going to be going over in this video, because if you're in your 40s, your time isn't as much as somebody who's 25, but that does not mean that there's no opportunity for you to become wealthy. But it does mean you're going to have to get laser focused and extremely focused on becoming wealthy, and that requires some sacrifices, some hard work, and putting your money in the right places. And the first thing you want to do is you have to start by assessing your finances where they are right now. Number one, do you have any savings? Number two, do you have any investments, including a 401k or an IRA? Number 3, do you have any debts, and what kind of debts are they? Number 4, what is your income combined? Number 5, are you tracking your money? Number 6, what legal or financial shields do you have? These legal or financial shields could be things like a will, an estate, a trust. These could be things like LLCs and different insurances to protect you in case you get sued, to protect you in case something bad happens. Now, this is where the first thing that you have to do in order to start improving your finances is you got to get a picture of where you are right now, because everybody's going to be in a different boat. Somebody's going to have $3,000 worth of debt, no savings, no investments. Somebody else is going to have $40,000 worth of debt with $100,000 worth of assets, and somebody else might have no debt and $500,000 worth of investments put aside. And this is where you got to create that picture of where you are today and where you want to go. And the way you want to start this is you take a piece of paper, take a Google sheet, does not matter, and you want to write down these numbers, right? Number 1 on the top, what is your income? How much money are you making, and what are the sources of this income? This could be a job, this could be a business, this could be your investments. What is the income that you're making? Then below that, you want to write down your expenses. Now, this is going to be a detailed list of your expenses. You want to take a look at your credit card statements, your debit statements, and your bank statements to see where is your money going. Is it going to restaurants? Is it going to groceries? Is it going to gas? Is it going to your car payments? Is it going to your mortgage? Is it going? Write down all the different places where your money is going. Categorize it. That way now you can see your income, then you see your expenses. Then after the expenses line items, that's where you want to write where else your money is going. How much money are you putting towards your investments? How much money are you putting towards charity? How much money did you put towards your savings? How much money did you put towards anywhere else that's not listed above? Maybe you're saving money for a down payment on a home. Maybe you're saving money to buy a car. Maybe you're saving money to buy a watch. Write that there as well. That way you know exactly where your money is going. Now you have a picture of where your money is going, and then you should also be writing down all of your debts and all of your other assets here as well. This is going to give you a starting point, because now you can take a look at this and say, how far are you from being able to become wealthy? Because remember, 3 factors: time, dollars, and return. We can't change the time, but we can influence the dollars and the return that you get on your money. And this is where now the most accessible place to start is by being able to invest more dollars. The more dollars you invest, the wealthier you will be able to become, period. Because, well, if someone's investing $1,000 and somebody else is investing $5,000, you have the ability to see more return on your money if you can invest more money, assuming you invest your money into a good investment. So now, how can you invest more dollars? You're going to have to figure out either A, how can you earn more money so you have more money to invest, or B, how can you cut back on your expenses? And this can be very difficult, especially if you're in your 40s, because now you feel like you're established in your career and you don't want to be cutting back now to start putting money aside towards your investments. But you're going to have to get real with yourself, and we're going to go over some numbers where you're going to have to put in the sacrifice right now, do whatever it takes, because if you do not have a solid plan towards building wealth or retirement now, you are going to have to get extremely committed, because you don't have the same time as somebody who's 21 or 25, and so you have to get extremely committed and make double the sacrifice, because if you want to be able to live wealthy, live financially free, and not have to worry about money anymore, you're going to have to put in that sacrifice now. And yeah, it's not as fun to do that when you're in your 40s as compared to when you're in your 20s, but either you're going to look back when you're in your 50s and 60s and say, thank God I made the sacrifice when I did, or you're going to look back and say, man, I wish I did. And that's going to be that decision for you to make. So you got to start by assessing the situation that you're in right now. And then the second thing that you have to do is you're going to have to build the order of operations now of how you are going to get the wealth and the financial freedom that you want. We're going to build out these order of operations. And then number 3 is you're going to have to attack this order of operations. So you're going to assess, build the right order of operations, and then attack this order of operations. And now when you're talking about this order of operations, there are 7 things that you need to work on. The first thing that you need to do is you have to make sure you have your base foundation built, your base savings. Number 2 is you have to attack the high interest debts. Number 3 is you have to build a financial system. Number 4 is you have to make your lifestyle adjustments. Number 5 is you have to manage and create the right investments that give you the best rate of return possible. Number 6 is you have to look at your income. And then number 7 is when you're going to look at your other debts. So let me start by building that financial base, starting with building that base savings. If now you don't have any savings, and by savings I mean an emergency savings cushion that's there not to make you rich, that's there not to help you buy investments, that's there not to help you buy a car, that's there just to protect you against an emergency. Your emergency fund, as some people like to call it. If you don't have any savings, the first thing you got to do is save $2,000 ASAP, because if you don't have $2,000 saved up, you are in a financial danger zone. Because what happens to so many people now in this instance is when you have no savings put aside, guess what? Life happens. And by life, I don't just mean someone's having a baby and they got to go pay for a baby shower gift. I mean, your car breaks down, your AC breaks, your window breaks, your kid breaks their arm. Something happens. And that something is expensive. And when you don't have savings to cover that expense, well, what do? You put it on your credit card. Now, not only do you have to pay that expense back, but then you got to pay it back plus 19% interest, which means instead of paying that $1,500 to fix the problem, you now have to pay $2,200 because you had to pay the $1,500 from your credit card and then another $700 in interest because it took you so long to pay it back in the first place. So the first thing you need to do right now is get extremely aggressive to put at least $2,000 aside before you do anything else. Before you worry about putting money in the stock market, before you worry about putting money anywhere else, you got to save this $2,000 ASAP. And the way that you do that is you got to get very aggressive now on not spending money on anything. If you do not have $2,000 put aside to protect you against an emergency, you should not be spending money. You should not be going to restaurants. You should not be having a Netflix subscription. You should not be having any music subscriptions. You should not be having a massage membership. You should not have any of these payments because this is a financial danger zone. And trust me, I know this one's not fun to do. But without this, you're never going to be able to achieve any real wealth. So until you have the $2,000 saved up, no spending money on anything unless you need it. Absolutely need it to survive. You need a pair of shoes. You don't need the new Jordans. You need a place to live. You don't need that nice home. You need a car to get to and from work, but you do not need that Beamer. Put aside the $2,000, and then the next thing that you got to do is you have to then pay down the high interest debts and attack that. And the reason why now we're talking about paying down these high interest debts before we talk about going out and investing your money in the stock market or trying to go out and buy rental properties and create cash flow and build that wealth is because your credit card debt is costing you a lot of money. Credit card debt is 14 to 25% interest rate, sometimes more, but in that range. Your investments are paying you 7 to 10% historically on average, which means if you go out and you put your money into the stock market or into the real estate market and you get an average return of, let's just say 10%, which is pretty good. If somebody got 10% a year on their stock market portfolio, that would be considered a great return. But then if you have to go and turn around and pay 15, 20, 25% on your credit card debt, you are losing money. You are losing wealth because now you're getting 10% and you're paying 20%. So this is where right now, before you go out and worry about investing your money to grow your wealth, you got to stop the financial bleeding, which means you got to pay down your credit card debt. Because the funny thing when it comes to the topic of investing, everybody talks about how can I get better returns? How can I increase the velocity of my money? How can I make my money faster? How can I double my money quicker? Well, do you want to know who's doing that very quickly at your expense? Your credit card company. Because guess what? Your credit card debt is a liability for you. It's an expense for you, but it's an asset for your bank. It's an asset for your credit card company because now your credit card company is getting the 20% return every time you spend a penny on your credit card. Now look, I love credit cards. I use a credit card for everything because I get cash back, I get perks, I get spending and fraud protection. But I also never pay a penny in interest. If you are paying interest on your credit card, you are using it the wrong way, and you should not be using a credit card. Maybe at some point in the future, you can consider using a credit card, but right now, if you have credit card debt, you should not be using a credit card, and you got to pay down this credit card debt ASAP. There are no exceptions here. You have to pay down this credit card debt because it is skinning you alive. The third thing that you have to attack once you pay down this high interest debt is you have to build now a financial system that's going to make you wealthy before it makes everybody else around you rich. Here's the reality of how our economic system works. The more money you spend, the richer somebody else makes. When you go to Chipotle and you spend money, Chipotle gets richer. When you go to Lululemon and you buy some new leggings, they get richer. When you keep that money in your pocket or when you invest that money, now Chipotle and Lululemon are not getting richer, but you're making yourself richer. Our entire economic system is designed to get you to spend your money. And not just that, it's designed to get you to spend money you don't have. Because now, when you go into Lululemon and you don't have the money to buy those leggings, the $100 or $200 leggings, well, what do? Well, you could walk out, which is not good for Lululemon, but you could buy it with 0% APR, or you can put it on your credit card, or I'm sure they probably have their own credit card. I don't know if they do or they don't. But now you just bought something with the help of debt. Now it's a double whammy for you, but it's making somebody else rich, because now when you buy this on your credit card, not only are you making the banker richer, but now you're buying something that you wouldn't have bought in the first place, which is great for the economy, it's great for Lululemon, it's great for the corporation, and it's great for the investors, but it's at your expense. And this is where right now, your job is to make yourself rich before you make everybody else rich. And the way that wealthy people do this is they always, 100% of the time, is they pay themselves. They work to make themselves rich before making everybody else rich. And the way you do that is by investing your money before you spend your money. You invest and save first, and then you spend whatever's left. The majority of America, and this is why the majority of America is broke, the majority of America spends their money first, and then they'll save or invest whatever's left. And when you do that, guess what? Most of the time, there's never any money left over, because it's very easy to spend money, but it's not as easy to invest or find that money to invest. And so this is where you need to build a financial system. It can be very simple that will allow you now to always have money to invest. And that means you can build something like a 75-15-10 plan. This is a very easy way to start, which says that from now on, for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. We'll talk about where to invest in just a bit. And 10 cents is the minimum that you're saving. Now, whether you're earning $20,000 a year, $200,000 a year, or $2 million a year, it does not matter. This system is going to scale with your income. And the first response that everybody has to this is, but Jaspreet, I'm barely getting by as it is. How do you expect me now to live off of only 75% of my income? Well, the response that I always have, you probably heard me say this, is if the government was to impose a brand new 25% tax on you tomorrow, what are you going to do? Complain, cry, let a letter to your senator, but then you're going to find a way to pay it, because if you don't, you're going to end up in jail. And so now you are taxing yourself, not to make the IRS richer, but to make yourself richer. So you have to build some sort of system that is going to now make sure you pay yourself first. And by pay yourself first, I mean making yourself wealthier before you make everybody else wealthier. Then once you create this type of system, I want you to create 3 different bank accounts and go to your bank. You can create these 3 different bank accounts, and the reason why is because you want to separate your money. You want to have a separate checkings account for your spending money. Then you need to have a separate savings account for your savings money, and then you need to have a separate third account. This could be a checkings or a savings. It does not matter. It just depends on what you want to do with it for your investment money. Don't tell the bank this is an investment account, because they're going to think of it as something completely different. To the banks, an investment account is something different. They have their own definition of an investment account. You just need a separate account, whether it's checkings or savings. That way you can store the money that you want to invest. Then there are many banks that will do this completely free, that will allow you to build automated systems that will automatically pull money out of one checkings account and move it into the second and third account. That way now every time you get paid, you have this direct deposit that now is going to pull money out of your checkings account from your paycheck, put some of this money into your investment cash account, and put some of this money into your savings account. That way now you don't accidentally spend your savings money, and you don't accidentally use your investment money to finance a brand new pair of leggings from Lululemon. And this is where right now you have to build this. And you might think, but why do I need to go out and create these 3 different bank accounts? Isn't that overkill? Well, it's much easier to spend less money when you don't see that money. When you see that cash in your bank account, we as humans, especially as humans in America, because we live in a consumerism society where we are bred to spend money. We are bred to have what I call net zero thinking, which is if I have $1,000, I need to spend $1,000. This is our society here in America. It just is what it is. So now how do you beat that? Well, you just start changing where the money is, because now when you look at the money you can spend and you don't see anything in there, you can't go out and spend more money. So now you have your separate savings account, you have your separate investments account, and now you have your separate savings account. The thing that I want to mention about your savings account is you don't need to save your money forever. because your savings are not there to make you wealthy. Your savings are just there to protect you against an emergency. Now, there are savings accounts finally online that will pay you some interest. Like as of the time I'm recording this video, there are online savings accounts that are real banks that are FDIC insured that are paying 3, 4, even close to 5% in interest a year on your savings. It's not a CD, so your money's not tied up. You can pull your money out whenever you want. And these are FDIC insured banks. So if you want to earn some interest on your savings, consider moving some of your money to one of these high interest savings accounts. But you need to set a savings goal for yourself. In the beginning, it was just that $2,000. Now, as you're working to build this real savings, you want to have somewhere between 3 months and 12 months worth of expenses. And I know this is a big range, and the reason why is because everybody's different. Some of you are going to be big risk takers. You don't need the savings. Maybe you don't have a whole bunch of financial responsibilities, so you don't need as much of a savings account. Others of you are going to be much lower on that risk tolerance. You feel like you have a lot of liabilities. You want to have as much cushion as possible that we never have to worry about money and stress about money. In that case, you want to have a bigger savings account. So you figure out how much savings that you need, and then you're going to keep saving your money until you hit that savings goal. Once you hit that savings goal, you're going to reallocate the 10% that was going towards your saving now towards your investments, because your investments are what is going to make you wealthy. Your investments are what's going to be working to increase how much income you get. They're going to be working to produce you cash flow. They're going to be working to appreciate in value. That way you can become rich. That way you never have to worry about money again. Wealth is built through owning assets. It's not built through having a big income. This is a big misconception here in America, because most people in America are working for a bigger income, and then they use that bigger income to drive a nicer car and live in a bigger home. And that's why most of America is broke, because, well, that car and home isn't putting any money in your pocket. But the few percent of people that are wildly successful, it's not that they're rocket scientists, although some of them might be rocket scientists, but a lot of rocket scientists are broke too. And the reason why is because, well, what wealthy people do, these are financially educated people, is when they make their money, they want to buy assets first. They want to own the investments, because these investments will continue to pay you even when you're not working. There's a limit to how much you can earn from your job, but there's no limit to how much you can earn from what you own. And this is why the wealthiest people in the world are focused on owning more assets. See, we in this consumerism society are obsessed with spending. And look, there's nothing wrong with having nice things. I want you to have the luxury things. I want you to have the nice things. I want you to have the nice car. I want you to have the big home. I want you to go on the nice vacations. I want all those things for you. That's why we're working hard. That way you can have the nice things that money can buy. It's no fun to just have a big bank account and never be able to actually enjoy that money. But in order for you to actually be able to enjoy that, I want you to be rich first. I want you to be wealthy first. And in order for you to be wealthy first, that means you got to own the assets first. Because when you own the assets, if you have investments that are paying for all of your expenses, well, yeah, who cares? Go out and buy that expensive car. Go out and buy that expensive vacation. Go out and buy that stupid watch. It does not matter, because you can afford it. At that point, it doesn't matter what the price is. You have investments, your assets that are paying for you to do that. But in order for you to get these investments, you don't have to be born a multimillionaire. You don't have to be born to rich parents. But you have to make that financial sacrifice to have more money to invest. You can spend less and you can work to earn more. Now, we talked about different ways that you can spend less, right? You got to make the sacrifices. But this is where right now you got to figure out, how can you have more money to invest? And then the next natural question is, well, where do I invest my money? Which brings me to point number 4, which is the lifestyle adjustment. Now, we already kind of covered this, but the reality is most Americans are broke, not because of their incomes, not because of their boss, not because of the government, not because of banks, but because of the lifestyles that we have and because of the decisions that we make. Now, I know that's hard for a lot of us to hear, because we never want to blame ourselves. It's much easier to blame everybody else. But when you're pointing your fingers and blaming everybody else, there's 3 fingers pointing right back at you. Now, we covered this story in Market Briefs recently, but the vast majority of Americans are living paycheck to paycheck, as in more than 50% of Americans are living paycheck to paycheck. And this is where most people say, well, if I earn more money, then I'd be able to solve my financial problems. But that's not the case, because what we've also seen is that the majority of Americans, more than 50% of Americans earning over 6 figures a year, more than $100,000 a year, are also living paycheck to paycheck. It's not how much money you make. It's what we do with the money you make. And what we've seen statistically is when the majority of Americans get a bigger raise, they get a bigger salary, they dig themselves into a deeper financial hole because now you have more access to spend. And banks look at you and say, oh, you're making more money? How about a bigger line of credit on your credit card? How about a bigger home equity line of credit from your home? How about a bigger cash out refinance? How about more debt that we can go out and spend? Now, what the majority of Americans do with that is they go out and they buy more liabilities, things that lose them money, things that make them look rich, right? You have all the fancy brand name stuff. You got the nice car, you got the big home, you got the nice vacations. And when you finance all these things, not only do you have to pay this money back, but then you got to pay interest, which means now your future income is being used to pay for yesterday's spending. And now you're living this rat race. You're working to spend, you're working to pay back the bills, and you're working to pay off the interest. And when you live in that cycle, you are never going to have the ability to get ahead. And this is where right now, the most accessible thing that you can do, not the easiest, not the funnest, and not the nicest thing to do, but the most accessible thing that you can do is give yourself a lifestyle adjustment, which means now you got to cut back on some of the crap. Now, this is now fun, right? When you go from ordering the double guac at Chipotle and then you stop ordering extra guac, that's not fun. It's not as tasty of a bowl, but you got to find the ways now to cut back on your expenses. That might mean that you can cut back on your home. Maybe you live in a smaller apartment for a little while, for a couple of years. Not fun, but you can save a lot of money doing that. If you get rid of the BMW that you financed and now you go to drive a Toyota Corolla with cash, you're going to save a lot of money every single month. Not just on the premium gas, not just on the insurance, not just on the maintenance, but also the monthly payments that you don't have to make anymore. And that's money that you can put directly towards your investments. When you get rid of some of the monthly subscriptions that you're not using, that are not adding any real value to your life, that's going to put some more money in your pocket. When you stop going out to eat so much, that's going to put some more money in your pocket. When you sacrifice a couple vacations, that's going to put thousands of dollars back into your pocket. Because right now, you got to get focused, right? We know the three things that are going to determine how wealthy you're going to become. We can't change the time, but you can change the dollars and the return. I haven't talked about the return yet, but right now we're trying to get more dollars into your investment portfolio because that's going to make you wealthier. How do you get more dollars in there? Well, you can spend less or you can earn more. And the most accessible thing that you can do is make the lifestyle adjustment. That way you can spend less. Yeah, work to earn more too. That way you have more money going into your investments. But the most accessible thing that you can do is you got to learn how to spend less money. That way you have more money just throwing into your investments because that's what's going to make you wealthy. And again, this is now fun. Your friends are going to look at you like you lost your mind when you pull up in the Toyota Corolla after you were driving the BMW 4 Series. But this is your time to shine. And then a few years later, once you work to build that wealth, now you can go out and buy that BMW 6 Series, and maybe you can buy it with cash. That way you don't even have to worry about the price, and now you don't got to worry about the payments. And then when you go to pump gas, you're not going to be stressing about gas prices, which is probably one of the most ironic things in the world. You see people go into huge debt to buy these fancy premium gas cars, and then you start complaining about the price of gas. If you're complaining about the price of gas, the problem isn't the price of gas. The problem is the car that you're driving. And so right now, you got to figure out how you can adjust that lifestyle that we have less money going out. The fifth step that you have to then work on is where do you actually invest your money? How do you invest your money? And there's a couple of different categories of things that you want to pay attention to. Number one is, are you going to be investing your money into cash flow producing assets? Number two, are you investing your money passively or actively? Now, of course, here when you invest your money, it does help to keep up to date on what's happening in the financial world. The best way for you to do that is to actually read the raw data, read the press releases. But if you don't have the time to do that or the interest to do that, well, the next best thing is to join something like Market Briefs. Market Briefs is my free financial newsletter that I created where my team is working to break down what's happening in the top finance and business news every day into a fun, witty, and easy to read email. You can read the email in less than 5 minutes every morning, and it's completely free. I promise you, you're going to love it. And if you don't believe me, give it a shot. And if you don't love it, well, you can unsubscribe. It's completely free. You can join Market Briefs by going to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. So now when we talk about the different ways that you can get paid, cash flow versus non-cash flow, some investments like your rental properties, like stocks that pay out dividends, pay out cash flow. Other investments don't. Like you can go out and invest in real estate and hope to flip it in 6 months to 3 years or 5 years or whatever and make a huge profit. Same in the stock market. You can go out and buy stocks with the goal of trying to sell the stock for a huge profit in the future, or you can buy stocks that are going to pay you for doing nothing except owning the stock. This is called a dividend. A dividend is when a company is going to pay you every 3 months, generally, every quarter, and they're going to give you a check or deposit this money directly into your stock brokerage account for doing nothing except owning the stock. Now, what you have to understand about cash flow investing is you're not going to get rich by investing your money into cash flow, especially in the short term. Cash flow investing is a long-term game where you're going to have to constantly keep buying more of these cash flow producing assets and do this for a long enough period of time. That way now you can build a significant stream of cash flow, but it's not going to happen today. It's not going to happen next year. It's not going to happen the year after that, but you're going to have to stay consistent if that's what you want. Cash flow investing to build real wealth takes time and it takes commitment. And it takes you consistently putting more dollars into it. A lot of people think that, oh, if I buy some cash flow, I'm going to be rich. You don't get rich by buying cash flow. You have to make the money first, and then you use this money to generate cash flow. You got to get rich, and then you use this money to buy the cash flow. When you put enough riches into these cash flow producing assets, you're going to get more cash flow back. The general rule of thumb of what you're going to see from real estate to stocks is somewhere between 2 to 7% cash flow. That is kind of your general range. Sometimes a little bit less, potentially sometimes more, but generally $2 to $7 worth of cash flow, which means for every $100 you invest, you're going to get $2 to $7 a year in cash flow. Again, it's not going to seem like a lot of money, but now when you change that up to investing $100 a week, every week, over 10 years, now you can start to see where the cash flow starts to grow, because then when you get that cash flow, you can also reinvest that cash flow to earn more cash flow. So now you're slapping $100 every week to buy more cash flow. And then when you get that cash flow check, instead of taking that and using it to go out and buy something nice, you take that money and you use it to buy more cash flow. That way every 3 months, you're buying more cash flow because you're just throwing more money into this machine that's printing you cash. That is how you build wealth, by investing for cash flow. The alternative is, well, now you're not investing for cash flow. You are buying something for, say, $100 and you want this to go up to $200. Again, that's okay. It's just an alternative way to get paid. And this is where now you have to be able to analyze your investments. You have to know how to invest your money, and you have to know the different places where you can invest. Again, the two most well-known places where you can invest is in the stock market and into real estate. Now, if you want to get started in real estate by owning physical properties, it's going to take more money, it's going to take more time, it's going to take more resources, it's going to take more risk. There are alternative ways for you to invest in real estate by investing in funds online. I have some of these resources in the description if you want to see some of the companies that I work with. They are affiliate companies of mine. But it is a way for you to get exposure to real estate. Real estate generally is going to take more work, more time, more risk, and more money. With the stock market, you don't need as much time, risk, or money because you can just throw your money into the market. And this is where you have to decide now if you want to be an active investor versus a passive investor, or a hybrid of both. And if you ask me, the vast majority of America, 90 to 95%, maybe even 98% of Americans should be passive investors, but everybody gets attracted to the idea of being an active investor. And what that means is when you try to put your money in the stock market, most people think you have to find the next Amazon or the next Google or maybe the next Apple if you want to get rich. But that's not how the vast majority of people will get rich, because when you play that game of trying to find the next hot stock, most of the time, the vast majority of the time, you're going to lose. And most people don't have the psychology to know how to manage their investments, when to buy, when to sell, and when to hold. And most people don't know how to analyze their investments. Maybe you find some cool companies that you want to invest in, but how do you analyze the financials? How do you know if the cash flow is growing? How do you know if the profits are growing? How do you know if they're using their cash the right way? How do you know if the executives who are running the company are doing good things? How do you know how strong the moat is, meaning how hard it is for another competitor to come in and take their spot? How do you know if they're using the cash flow the right way? How do you know if they have good assets and liabilities on their balance sheets? If that sounds interesting to you, which unless you're a money nerd, that's not going to sound very interesting to you, you should be looking for something that's going to appeal to the interest and the time that you have. Being an active investor is difficult. This is what Warren Buffett spends his days doing. He's an active investor. He loves researching companies. He loves studying their financials. He loves studying the products. He loves studying the executives at their company. He loves studying the innovation. He loves studying the branding of the company. That's what he's doing. When you're investing in the stock market, you're literally buying companies. When you buy one share of Amazon, you become one of the owners of Amazon. And if you don't want to treat it like that, then you're essentially gambling. Sure, you can make some money. You might find a cool company that you like before it pops off, but you might not. And you might not have any way of knowing if your company is a good investment or not. If that's something you want to do, you want to invest in individual companies, fine, but just understand the risk. And the more research you do, the more you learn, the more time you spend, and the more money you spend learning how to do it, the better you're going to do. But again, this is long-term investing. I'm not talking about trading. I'm talking about long-term investing. If you want to invest in individual companies, understand that that is a real skill if you want to succeed. The alternative is being a passive investor. A passive investor is now, instead of you trying to find the next hot Amazon or the next hot Apple, now what you're doing is you're just investing your money into the stock market. You're investing your money into America. And if America grows and our stock market grows, you make money. And now you don't really have to try to find the best time to buy. You don't have to find the best price. All you're going to do is set up a system where now every time you get paid, you're just going to throw money into the market. And this can be completely passive. You don't have to spend any time doing this besides finding the right funds to invest in the first place. Then you just automate it, set it, and forget it. And so it's much less time, much less risk, because now if you invest in, there are funds, for example, that will give you exposure to the entire stock market. For example, there is an ETF, an exchange traded fund called VTI. It trades just like any other stock on the stock market. But when you buy one share of VTI, you are in essence buying the total stock market, which means now you're just getting exposure to America and the stock market. Now you have hundreds or thousands of companies that you're investing in. And so if one company goes bankrupt, it doesn't bankrupt you. It just gets kicked out, and now another company might come in. It gets balanced out by the losers. If one company goes really big, yeah, that's going to benefit you, but it's also going to be balanced out by some of the losers. So these funds, like ETFs, you can also look at index funds. Some mutual funds might also work. These funds are giving you exposure to baskets or groups of stocks, so that way you don't have to find the perfect company. But the key to win in this type of passive investing game is you got to just keep throwing money into the ETFs every week, every 2 weeks, every month. I am a passive investor and an active investor. I cannot tell you what to do. Do not blindly follow anything that I do, and I don't recommend what I do to anybody. But what I do is I have a passive investing strategy and an active investing strategy because I'm a weirdo and I like researching companies. Those numbers are very interesting to me. But I have a passive and an active investing strategy. In my passive investing strategy, every Wednesday, I don't have a secret sauce as to why Wednesday. Just for me, I picked Wednesdays because it's in the middle of the week. Every Wednesday, cash is leaving my bank account and it's automatically being invested into my portfolio of ETFs. I have ETFs that give me exposure to value companies, things like the S&P 500. I have ETFs that are giving me exposure to dividends. This is actually the biggest piece of my entire passive investing portfolio. I like dividends because I like cash flow. Cash flow is the bulk of my investment portfolio because my rental properties are there for cash flow, and the majority of my stock market passive portfolio is there for cash flow. So now I have the value, the S&P 500s, I have the dividend paying companies, the ETFs, and then I have some investing into innovation. This is a little bit more of the speculative side. These are more of like the growth potential type of companies. And then I also have ETFs that give me exposure to international companies, emerging markets, because that's kind of like a hedge. Because if things go down in the United States, well, some countries that don't rely on the United States, that don't rely on the dollar, might not be hurt as bad. And so it creates a little bit of a hedge. Now, again, every Wednesday, cash leaves my checkings account and it's automatically invested into my portfolio of ETFs. I don't touch it. I don't think about it. I don't worry about it. It just happens every Wednesday, whether the market's up, whether the market's down. And that's the key to win. Not only do you need the time now, where you're investing your money into these types of ETFs for a long time, but you're doing this in a way where it's consistent, passive, and automatic, because if you choose when to do it, well, you might miss a week. And when you're just waiting for the best opportunities, you're not going to keep investing your money. The way that you do this is whether the market's up or down, you're going to keep investing your money no matter what. The only change that you're ever going to make is potentially when you see markets drop, you could potentially buy more. But besides that, you don't change the system. That's how you win in this passive investing game, and you just keep throwing more money into it. Now, this is where you got to make the decision of, number one, where do you want to invest? What types of assets? Is it stocks? Is it real estate? Is it startups? Is it something else? You got to figure out the assets that it is that you want to invest in. Second, do you prefer cash flow, non-cash flow? Third, are you going to be passive or an active investor? And now you just kind of work down the list and you start taking the money that you're putting aside towards investments and you put it to work. Now, if you remember what I was saying just a little bit ago, that there are three factors that will determine how wealthy you become. Number one is the dollars. Number two is the return. Number three is the time. We cannot control the time, but you can control the dollars and the return. When you spend less or you earn more, that's influencing how many dollars you're investing. The next thing that you can do is influence the return that you're getting, and that's where now your investments are going to determine the types of returns that you're getting. If you want to get better returns, generally that means you might have to take on a little bit more risk. For example, you have the potential to get better returns when you actively invest your money versus when you passively invest your money. But the higher risk also comes with the higher potential to lose more money. And so now, how do you get better returns? You get more financially educated, because the more you learn, the more opportunities that you're going to see. And in addition to that, what else creates opportunities? Well, finding distressed assets. If you find a rental property that's beat up, that's in an area that's coming up, but it's just so bad that nobody wants to buy it, that could give you the opportunity to buy a good property that's beat up that you can fix up at a huge discounted price. It's the same thing in the stock market. If you find a beat down stock that everybody's selling that's on the verge of a turnaround, that can create opportunity for you. Again, higher risk because this company could then go into bankruptcy. But if you can buy it cheap, you can make a lot more money. And this is where now that financial education comes in. How can you find these types of opportunities? You can learn, you can start researching, or you can see more broad market opportunities. When you see a market crash, when you see a recession happen, asset prices fall. Why do asset prices fall? Because people start selling, people start panicking, people need money, so they cash out of their investments. And when people are selling, that creates an opportunity for people who are prepared to come in and buy. So if you want to see higher returns, you got to get more financially educated and get more involved with their investments, because that's going to allow you to get higher returns. And the higher the returns that you get on the money that you invest, the wealthier you will become. And now when time is a more limited factor, you're going to have to get more focused on that financial education, not just so you can invest more, but so you can get the better returns on your money. This brings me to then the sixth thing that you have to work on, which is your income. What happens now to 99% of people in this situation is you are now getting into this financial education game. You're working to put more money towards your investments. You're working to invest your money to build wealth. And now you realize, wow, this is kind of fun. I'm seeing the opportunity for success. I need more money to invest my money. This is now, it pays to earn more money. Because now when you earn more money, you're earning more money not to drive a faster car and have a bigger home and go on a nicer vacation. You're earning more money so you can have more investments that will pay for your nicer car, bigger home, and fancy vacations. And this is where now earning more money is so crucial, because now your time is more limited. You need to be investing more dollars. That way you can have more wealth. But in order for you to invest more dollars, there's only two options. Number one is you can spend less, which is what we've been talking about up until now. The second thing that you can do, which can allow you to make way more money to invest, to have more money to invest, is you got to earn more money. Now, how do you earn more money? Well, there's an unlimited number of options here. And the first thing that I want to say is, look, it's never too late to make a change. This is what's going to be probably the most difficult factor in your 40s. And what's interesting is, it's not just difficult in your 40s. It becomes difficult when you're 25. People who are 25 say, oh man, I'm committed to working in medicine. I'm committed to being an engineer. I'm committed to being an accountant. I can't change now. You're 25 years old. What are you talking about? And then you hit your 30s and you're like, dang it, I should have made that change when I was 25. I don't really want to be an engineer. I really don't want to be a doctor. I really don't want to be a teacher. I really don't want to be an accountant. I really don't want to be a technician. Well, then what happens is you just stick with it, because you feel like you've been in this career, in this industry for so long, you can't make a change because now you're older. Nobody wants to hire an older person. You don't have any other experience. And do you really want to start over? And then come your 40s. And then you say, dude, I was really young in my 30s. I was stupid for not making a change when I should have. But now I'm in my 40s. I've been in this career for so long. I have so many networks now. I've built myself in this experience, and I have this resume that allows me to have the job that I have. It's not the funnest thing. I don't really care about what I do. I'm not making the best money, but do I really want to, I'm 40 years old. I'm 45 years old. Do I really want to make a change now? That's what's going to happen. When you're in your 50s, you're going to say the exact same thing. When you're in your 60s, you're going to say, dude, I wish I would have made that change in my 40s or my 50s. Time is going to keep going on. Period. We're not going to stop the earth from spinning. We're not going to stop the days or the nights from coming. That's going to happen regardless. Time is going to go, but what you do in that time is something that you can control. And so if you're not happy with what you do, make a change. What's the worst that can happen? And if you don't want to just leave your job, that's okay. Start doing something in the evenings. Start doing something in the weekends. That way you can start learning. If you're an engineer and you want to go into medicine, or if you're an engineer and you want to be an entrepreneur, or if you're a doctor and you want to go and start selling cakes on the internet, that's okay. There's nothing wrong with that. Start figuring out. If you're not happy with what you're doing, it's not too late. Even if you're in your 40s, even if you're in your 50s, even if you're in your 60s, it is never too late. And you might surprise yourself at how many new financial opportunities you're going to find when you start doing something that you actually enjoy. Because when you start doing things that you actually enjoy, you don't feel the dread of working. And when you don't feel the dread of working, you end up working more. And when you end up working more, you tend to be better at what you do. When you get better at what you do, you have the ability to earn more money. When you have the ability to earn more money, well then, you can live a better life financially. And it can happen very quickly. People talk about how much I work. I work a lot of hours. I work 7 days a week. I like working. I work when I'm on my vacations. I do it because I don't feel a dread when I work. Actually, I get stress relief when I work. I like what I do. And because of how much I can work, it's harder for people to compete against me. And it allows me to also earn more money. And the funny thing is, I don't feel stressed out because of how much I'm working, because I like what I do. And this is where now you can create new opportunities for yourself, whether it is a career change, whether it's getting a certificate, whether it's working harder at your job, whether it's getting a second job, whether it's getting some sort of new qualification that we can earn more money. There's unlimited possibilities here. It is not too late to make a change. And if you don't believe me, I don't know, I can shake the screen to get it through your head, but you got to be the one to believe that for yourself, that it's not too late. If you don't want to do that, you can also work to create your own income. You can try to start a side hustle. You can try to start a business. You don't have to quit your job and change everything in your life and hope that you start making millions of dollars tomorrow. That's not how it works. But you can start on the evenings. You can start on the weekends. You can start in the mornings. You can work on a lunch break. You can find time to get committed, to start learning, to be better, to now creating the new income and doing something different that will allow you to live the life that you want. Because remember, you got to own the assets to become wealthy. How can you own more assets? You can spend less or you can earn more. We talked about how to spend less. This is where now, how can you earn more money? Not so you can drive a faster car and have a bigger home, right? You got this now. So you can invest more aggressively. And this then leaves me with number 7, which is talking about all the other debts that you have. You can talk about your car payment. You can talk about your mortgage payment. You can talk about all the other debts that you have, the lower interest rate debts, because in the beginning, we talked about your high interest rate debts. Now, when we talk about these other debts out there, the real key now is going to be dependent about what type of life that you want to live. Because if your goal is just to be financially free, I don't want to have to worry about money. I want to go to my backyard, never have to worry about payments again. I just want to be able to breathe without having anybody hovering over me. And I don't really care about having the nice stuff. I don't really care about the exotic things. I just want to live free. If that's you, then it makes more sense maybe for you to pay down the debt. And I said maybe for a reason. I'll get to why in just a second. If you say, you know what, Jaspreet, I want to change my life completely. I'm tired of living like crap. I want to have the nice things. I want to drive in Mercedes, BMWs, Rolls Royces. I want to fly first class. Maybe I want to even fly private. I want to have the nice exotic things. I'm so tired of living like this. Okay, that's fine. But the way you're going to get there is by taking on a little bit more risk than just paying down a 4% interest rate debt. And so now you got to figure out what type of lifestyle do you want to live and what is going to make the most sense financially. And the reason why is because now you got to take a look at your debts. Lay out what interest rates are you getting. If you got a mortgage back in 2020 or 2021 and your mortgage is 2.8% a year, now you're debating, what should I do? Should I pay down my mortgage faster? Or should I do something else with my money? Well, if one of your options is I can save my money into a high interest savings account that pays 4.5% and my mortgage is 2.8%, if this guaranteed savings return interest is paying a higher interest rate than my mortgage, well, then you can just put your money into a high interest savings account and then use the interest on the savings to help pay down your mortgage, right? Because at that point, financially, you have very low risk to get this return from your savings account. And so now you can get this return, and it's better for you to get that return on your savings because there's a higher rate of return than your debt. See, when you put your money into the stock market or into the real estate market, now it's different. Now, The goal is to get 7 to 10% a year, but you might also get minus 5%, which is where now if you have that low interest rate debt and you just want to be financially free, then sure, it makes sense to maybe not invest the money into the stock market or the real estate market because there's a chance you might not make any money. In which case, paying down the debt can give you a guaranteed return and can give you that lifestyle faster. But when you have the high interest savings accounts that are paying you 3, 4, 5%, and if that's more than what your debt interest rate is, well, now you might be better off by not paying down that debt faster because you can get the interest from your savings, and that might help you actually earn more and use those profits to pay down that debt even faster. And so this is where you just got to figure out now what type of lifestyle that you want to live. Again, if you want to live big, you want to have the nice things, you got to be willing to take on more risk. And taking on more risk means maybe instead of paying down the debt right now, you got to be investing into things like yourself that's going to help you earn more money. One of the best investments that you can make is in yourself. That means start by spending your time to learn. Watch YouTube videos, listen to podcasts, listen to articles, read books about ways to earn more money, ways to build a business, ways to grow a business, ways to scale a business, ways to be creative, ways to be innovative. Then as you learn, you start doing. You start investing into your business idea. And I can pretty much guarantee that the first idea is going to be a flop, but you got to get started. You got to have the first, to have the second, to have the third. And then as you do, you're going to learn more. And as you start to grow, that's when you can start investing into more education. Hire a coach, hire a consultant, somebody who's 5 years ahead of you, 10 years ahead of you, because they can teach you a lot that we don't have to go through the 5 or 10 years of pain and struggle that they went to. Yeah, they're expensive. I get it. Online coaches, business coaches, investment coaches are expensive. I've hired a lot of them. I've paid a ton of money in education, but if they can help you reduce how much time you have to spend learning to do it yourself, it might be a very good investment for you. Some of them might be crap. Some of them might be really good. And then you keep investing and building in yourself. And this is where now you are building that trajectory to build that wealth because now you will own the assets. You have the right income and you're spending money in a smart way that's allowing you to scale how many investments you have because that's how you're going to become wealthy. Building wealth is all about the velocity of your money. How fast can you grow your money from $1,000 to $10,000? And your job now is to figure out how you can accelerate the velocity of your money. And in order for you to change the trajectory to go from slow and steady growth to fast and booming growth is to focus on these 4 things. Number 1, you got to focus on your mindset. Number 2, your commitment. Number 3, your discipline. And number 4, your risk. Let me start by talking about your mindset because the reality is, look, we live in a day and age where people's mindsets are really influenced about what's happening outside, what's happening in the media, what's happening in the traditional media, and what people feel the consensus of on social media. And people generally, I'm not talking about everybody, but you kind of have this like general consensus of, well, I'm not rich, so I hate people who are rich. And I can pretty much guarantee that when you carry that mindset, it's going to be impossible for you to ever become rich. Now, how do I know this? We remember that whole submarine incident recently, which was so devastating, so heartbreaking. It doesn't matter if someone's rich or poor or something's going on. There's a lot of things happening in the world, but when somebody loses their life who's innocent, that's sad. And when you read through the comments, most of them were solely focused on the incomes or wealth of people that were inside of the submarine. And what did they say? Oh, these are rich people problems. Why are we trying to help rich people? Oh, that's what happens when you're rich. And I can guarantee you that when you have that mindset towards rich people that, oh, they're bad because they're rich, you are never going to have the opportunity to be rich because naturally we want to be good people. And if being rich is being bad, why would you want to go out of your way to become bad? And this is where you got to understand, look, money does not make you a good person. Money doesn't make you a bad person. Money is just a tool. It amplifies who you are. When you give a good person more money, they have a tool to do more good. When you give a bad person more money, they have a tool to do more bad. And so if you want to be wealthy, all you need is more money. And more money is not going to make you a bad person. It's not going to make you a good person. It's going to amplify the type of person that you are. And instead of hating the people who have money, you got to start asking the question of how did they get the money in the first place? And that simple switch in your mindset is going to completely change the trajectory of your life. And you might be thinking, oh, Jaspreet, that's just a bunch of woo-wah stuff. You can't just change your life by thinking differently. Yes, you can. And I'm not talking about this abundance. Oh, I'm just going to pray on money and money's going to come and fall on my laps. That's not what I'm talking about. I'm talking about changing the way that you think. There are some people out there who think the world is against them. And when you think the world is against you, what's going to happen? Well, you're going to constantly be paranoid and not want to build trust with people, not want to network with people, not want to build businesses and relationships with people because you're going to think the whole world's going to be against you. And as soon as something goes wrong, as soon as something happens in that business, I knew it. I knew the government was going to be after me. I knew customers were going to hate this product. I knew that the internet was going to not like this. I knew that people were going to try to shut me down. Well, you could change that same person. If you put them in a different mindset, it could be completely different. Because guess what? Every idea is going to have problems. People are going to hate on every idea in the world. There's a meme on the internet that says, if you don't want to upset people, just sell ice cream or something along those lines. Well, guess what? Even if you sell ice cream, someone's going to be mad. People are going to have issues with everything that you do. They're going to have issues when you don't do things. They're going to have issues when you do things. That's a part of the world. There's going to be issues of regulations. There's going to be issues of a lot of things. And so now if you expect that to happen, and that's going to be the overwhelming force of why you can't become successful, you can guarantee you're never going to become successful. And this is where that mindset of now understanding the way you think is going to influence what you do. And what you do is going to influence what you get. But it all starts with their mindset, right? I call this the minority mindset because the minority mindset is about thinking differently than the majority of people. And the majority of people, especially in today's day and age, we live in this complaining society. We live in this self-misering society. We live in this victim mentality. We live in this society where we want to blame instead of wanting to change. Because guess what? It's easier to blame, right? When you feel crappy about where you are, especially financially, it's easy to blame your government and the boss. Man, it's because of all these taxes that we have to pay and all this government spending that we're broke. It's because my boss isn't paying enough that I'm broke. It's because my landlord keeps raising the rent that I'm broke. When what you'll see is some people in the same situation will be able to win despite all that other crap. Because guess what? There's a lot of crap in the world, period. Now, either you're going to go in with that mindset of despite the crap, I'm going to win, or I'm going to let the crap just parade on me. And you got to make that decision for yourself. Which one do you want to be? And this starts here. And I know this one is difficult because I've encountered a lot of different people and worked very closely with people with very different mindsets. And even if somebody is not skilled, they have no idea of how to do a particular task. You might have very little talents, but if you have the mindset of I'll do whatever it takes, you're going to have a much better shot at succeeding than somebody who's very educated, very skilled, very talented, but believes the world is against them and everything is against them. It's not about the skill and the talent, but it's about your mindset towards things. And then, now, if you're in this situation, you got to be honest with yourself. I'm not telling you to go immediately change your mindset because that's not how it works. I get that. In order for you to change your mindset, if you feel like, you know what, I feel negative. Yeah, I do complain about other people. I do complain. I get jealous when I see people who are rich. I get envious when I see people who are rich. I get upset when I see rich people doing things. I get upset when I see people have nicer things than me. I wish I had the nicer things. Okay, all right. I'm just saying accept that and understand that. Because this is now going to be a process, and this is where you got to start. And the way that you do that now is you're going to start diving into that personal development side of things. And now, look, you're not going to change your mindset tomorrow. That's not how it works. But you got to start absorbing things to change the way you think. Because if you are constantly hating on other people, you're hating on other people's success, you wish you had the success, and you just feel miserable because you don't have it, and you're constantly complaining. And if you don't know this yourself, ask other people. If people around you say, man, you got a negative attitude, or they're telling you this, take that for what it's worth and start reading some personal development books. Start listening to personal development podcasts. Start watching personal development videos. Things about mindset, things about growth mindsets, things about thinking bigger and abundance. And again, with abundance, I'm not saying you got to sit there and just meditate that, oh, everything's going to be bigger and better. No, that's not what I'm saying. I'm talking about just thinking that there's more opportunity out there. Because when you think there's more opportunity out there, you're going to start taking actions very differently. And when you start taking actions differently, you're going to see a whole new world of possibilities. And the life kind of works in this very weird way where we think that your trajectory in life is going to be this linear transaction. But that's not how it works. Life and success kind of work like a pinball machine where when you shoot a pinball, the pinball just goes everywhere. It goes up, down, circular, sideways, left, right, circular, straight, up, back. You never know where you're going to go next. And
the most weird things might take you to a different trajectory, but that is what allows you to see the opportunities. There was somebody who was saying that success and opportunities are like buses. And you only learn the bus schedule when you actually have to get somewhere. That's when you're going to actually notice the bus and be able to get on the bus. Those buses keep running, even when you're not paying attention to them. But the only time you're ever going to pay attention is when you see the bus, when you see the bus schedule. But in order for you to see the bus schedule, you have to be willing to see the opportunities in the first place. I started off throwing parties in college. In fact, before parties, I was playing a drum at Indian weddings. Playing that drum at Indian weddings got me to meet DJs. Meeting DJs got me to start hosting parties. Hosting parties got me to realize I hated hosting parties. But that gave me money to start investing in real estate. When I started investing in real estate, I got my real estate salesperson's license. When I got my real estate salesperson's license, I became a real estate wholesaler. When I became a real estate wholesaler, I realized that I needed to do something more scalable. When I started doing that, I started getting more on the internet. I started e-commerce stores. When I started an e-commerce store, I got screwed over. When I got screwed over, I started a class on how to launch a business without getting screwed over. When I started that class, people said I need to get on social media, so I got an Instagram. When I got an Instagram, people said I should start a blog. But English is my second language, so I didn't want to start a blog. Instead, I started a YouTube channel. Then I started a YouTube channel, and that gave me the opportunity to start something like Briefs Media. When I started Briefs Media, that opened up even more doors for me. So you can see it was a pinball. I go from one place to the other, to the other, to the other. And when I was 18, 17, 19, I would have never predicted where I would be in 5 years, 7 years, 10 years from then. But this is where you cannot expect what's going to come next and think, oh, this is not going to help me get to where I want to go. You just got to get started. Life is a pinball machine, but you have to start by changing that mindset. That way you can actually get to the next place that you want to go. The second thing that you have to work on if you want to increase the velocity of your wealth is your commitment. And this might be as a business owner. This might be as an employee. This might be as an investor. And the biggest thing that I hear, because especially in today's culture, is, oh, I don't want to do too much at my company because I don't like this idea of doing more than what I'm paid for, right? We talked about quiet quitting. We talked about all these things happening in our culture right now where people are like, I don't feel like I'm treated good enough in my company. But you want to know what is a common trait amongst 99.9% of leaders, 99.9% of executives, 99.9% of overly compensated people, is they had to go through a whole bunch of time of being undercompensated for what they did. These are the people that were the overachievers, that did more than what they were paid for, that did more than what they were asked for, and went out of their way to succeed. So now, if your goal is to be overpaid, the way that you become overpaid is by being underpaid first. And you might feel like, oh, what are you talking about? You mean I have to go to work and work harder and do things for my boss and make my boss richer? Yes. If you are an employee, the best way to get richer, meaning through your income, not through your investments, right? We know that investments are how you really become wealthy. But the best way for you to make more money is by making your boss richer. Now, that might seem really counterintuitive, but the reality is if you are the person that gets into work early and you're overachieving and you're working harder and you're outperforming everybody else, who's going to be the first person to get that promotion? You. Now, you might be saying, oh, there's office politics. If your office politics are constantly overlooking you and treating you bad, go to a new company. Every company is not bad. Are there some crappy companies out there that pick the wrong people consistently and that are picking whatever the word is, they're picking the wrong people? Then leave the company. Go to a company that will appreciate your hard work and your dedication. Because when you are the most valuable person in your department, the person who's going to get that bigger raise, the bigger promotion, that's going to be the last to get laid off, that's going to be the person that gets the most praise financially, is going to be the person who's constantly busting their butt. Because from a company's perspective, what they want is valuable employees. And when you become more valuable, they're going to be willing to pay you more. And the reason why they're going to be willing to pay you more is because you have something that 99% of the other employees don't. And in order for you to do that, you got to make that commitment to put in the work. If you're just trying to coast by, I can guarantee you're always going to be struggling because that's the mindset you have towards everything in life. If you're just trying to get by and do the minimum amount of work, you're never going to be able to see that success that you want financially, that real financial success. If you're okay with where you are, then fine, keep coasting. You want to be average? Fine, keep coasting. But if you really want to scale, you really want to earn more, you want to see that top level, you want to be the top dog in your company, you're going to have to outwork people. You're going to have to outperform people. You're going to have to outdo people. And you're going to have to put in that commitment in order to do that. And sometimes, guess what? You're not going to get compensated right away, but you're going to have to keep doing things that people don't see. When I first started my YouTube channel, it's kind of funny. I think it took me almost a year and a half of constantly making my videos before I got my first YouTube payday. That meant I was putting out 3 videos a week after week after week, month after 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 month. And let me remind you, I am a licensed attorney. My time is valuable. I could charge a lot of money to review contracts and to do business legal work. But I kept making YouTube videos. And for the first almost 18 months, I didn't get my first check. And when I got my first check, it was a few $100s. My first check of almost a year and a half worth of work. That's a lot of commitment to something that's not making me any money. But today, guess what? I'm getting overpaid on YouTube. Why? Because I got underpaid in the first place. If you want to get overpaid, you got to get underpaid in the first place and put in the work that other people are not willing to do. The third thing that you have to fix if you want to accelerate your velocity towards wealth is you got to fix your discipline. Now, discipline is a lot of things, right? Once you start building that commitment, you're going to be working on that discipline to get to work, but it's also the discipline financially, because the reality is becoming wealthy is as much mindset as it is what you do with your money. Because the thing that holds so many people back from becoming wealthy is, you're telling me I got to invest my money today and invest it for years before I see any return? Yeah, that's the whole name of the game. And people have to see that light at the end of the tunnel right in front of them, because they need to see the return today. I need an instant gratification. I need to see the growth today. I want to double my money in 6 months. And when you don't have the discipline of knowing to trust the system, trust the process, and continuing putting in the reps, it's very hard to do that. It's the same reason why it's so hard to lose weight, because unless you see the success quickly, it's very hard to stay committed. But the reality is, we know, right? If you want to get in shape and lose weight, what do you got to do? You got to eat better. You got to eat healthier. You got to put in more exercise, period, right? Now you can get into all the nitty gritty of the types of nutrition and the types of diets and the types of exercise that you do. But at the end of the day, you got to eat better. You got to work out more. You got to put in more reps. And now, maybe in the beginning, you start to see a little bit of success, right? Because when you go from really fat and unhealthy and you hit the gym for the first time and you start eating salads for the first time, yeah, you might lose some weight very quickly. But then you kind of hit this plateau where, yeah, you got 2 months of solid success. And now you're in month 3, and now things are starting to get hard. Because now, yeah, you're not eating as many Twinkies and Ho-Hos anymore. You're not eating the pizza like you were anymore. You're starting to miss the McDonald's. You're starting to miss all the unhealthy foods. And you're also like, I haven't really noticed a difference in my body in the last 2 weeks. Do I really want to keep putting in this work? And now you're going to be put to the test. What do you really want to do? And the people that are going to win are going to keep putting in the reps, because you got to keep working. And of course, yeah, you got to keep improving the types of reps that you're doing. You got to work on your physical and financial education, but you got to keep putting in them reps. And it's the same thing financially. You got to keep putting in the reps. You got to keep investing your money. Sometimes you're going to see down markets where you're going to feel like you're losing money. You got to keep putting in the reps. Sometimes you're going to see bad things happen in the economy. You got to keep putting in the reps. Sometimes you're going to see the economy booming. You got to keep putting in the reps. Sometimes you're going to lose your job. You got to keep putting in the reps. You got to keep doing the things that are going to make you wealthy, right? You got to keep investing your money. You got to keep living below your means. You got to keep working to build up the savings cushion. You got to keep working to build up the cash flow, because that's what's going to make you wealthy. And in the beginning, sure, it's exciting. Oh, I'm going to get rich. And then you start getting those offers of how you can get rich in 6 months with the 6-step formula. All you got to do is pay me $997. Now, I'm not hating online education. I actually love a lot of online education, but there's a lot of crap out there too. And if all you're trying to buy is that way to get rich in 6 months, well, what do you think is going to happen? Because now you're trying to get away from the real process. You cannot bypass hard work. You cannot bypass the commitment. You cannot bypass the sacrifice. You cannot bypass the mindset. You cannot bypass the discipline, period. It takes discipline if you want to be able to succeed. And you got to make sure you're putting in the reps, even when things are hard, if you really want to be able to see that success financially, physically, in any part of your life, even in your relationships. Guess what? Things are going to get hard with your wife, with your husband. Things will go through rough patches, but you got to keep loving that spouse. You got to keep coming back and showing them love if you want to be able to make it work. Everything is going to go through tough phases, but you got to be willing to have that discipline to keep coming back and keep putting in the reps. And the fourth thing that you have to work on if you want to increase the velocity of your money is your risk tolerance. The biggest thing that I hear, the biggest criticism that I hear about investing is, what happens if I lose money? What happens if I buy an investment and then it goes down? What happens if the economy crashes? What happens if the market crashes? Well, let me tell you this. You are going to lose money, period. When you invest your money, everybody will lose money at some point, period. That's not just a possibility, it's a fact. Every single person in the game has lost money at some point. But when you don't take that risk, you're also guaranteed to lose money. Because now, not only are your savings going to lose value to inflation, but you're also missing out on huge opportunities. That's a loss too. Because if you don't invest your money and you don't see that growth, there's a risk to that. Because you might be broke now, scared to take that risk, and then you're going to be broke 10 years from now too because you didn't take that risk. And so this is where now you have to understand risk is associated with the game, but that's how you learn. You learn through mistakes. You learn by putting your skin in the game. You learn by actually putting your money to work. I have lost money in investments. I've talked about this openly. I made a video on my YouTube channel talking about my worst real estate deal ever. If you haven't seen it yet, go ahead and watch it. See what it's like to lose money. I will walk you through the deal. I walk you through the deal and show you all the things that went wrong because I was early. I was young when I bought that deal. I did not know what I was doing. And I made every mistake possible. And you'll see the stress and the financial stress that I went through. It was not a fun time, but I learned so much in that one deal that you cannot bypass that work. Yeah, it was very stressful when it happened. I can look back and laugh at it now. I can look back and talk about all the funny things that happened now. But during that time, it was very stressful. I was losing a lot of money at a time when I didn't have that money to lose. But that's a part of the game. You got to be willing to go through the process. And what's interesting is as you get bigger, the risk also gets bigger. When I was first starting off in my event planning companies, my first party was a flop because we had some issues with the original club that we were going to work with. That lost me maybe $1,000, which was like a ton of money for me back then. That was pretty much all the money that I had in my bank account. When it was my worst real estate deal ever, now we're talking tens of thousands of dollars, which was, again, pretty much everything that I had in the bank account. It was a lot of money. And then going forward even more, when I was running the Minority Mindset trying to build a blog, I spent $500,000 trying to build a blog because I hired the best consultants. I built a team and I was just trying to throw money at the problem, trying to fix it. It was a complete flop. $500,000 down the drain. Yes, risk comes, but without that risk, you're never going to be able to see the growth. And this is where you have to get started, but also understand that those mistakes are not killers of your total financial success. You might have lost a deal, but you'll lose the investment. You'll win the investment game if you keep coming back. And yes, you're going to keep learning. Every phase in your life is going to have new risks, new lessons, and new education, but you got to be willing to come back each and every time. And the reason why all these topics are so important for you to understand right now is because of all the risks that we have in our economy right now. The United States of America needs a recession to save our economy. At least that's according to JP Morgan Chase Bank, who says that our economy needs a recession. Let me read you what JP Morgan Chase Bank, the largest bank in the United States, said in a note to their investors. They said, while the United States economy's recent resilience may delay the onset of a recession, we believe that most of the lagged effects of 2022's monetary tightening have yet to be felt, and ultimately a recession will likely be necessary to return inflation to target. What does that mean? In 2022, the Federal Reserve Bank started raising interest rates for the first time. We started off slow with those 25% interest rate hikes, the 0.25% interest rate hikes. Then we got more aggressive with the 0.75% interest rate hikes, and we continue to do that throughout all of 2022, and we have continued to raise interest rates a little bit in 2023. And what JP Morgan Chase Bank is saying is that we haven't felt the full effects of last year's interest rate hikes, and we're still raising interest rates now. Now, in order to bring inflation down, right, the Fed has to raise interest rates, and there is a lagged effect, a delayed effect to the pain from higher interest rates, which you haven't felt yet. The general rule of thumb is that it takes somewhere between 12 to 18 months to feel the effects of interest rate hikes. We're now starting to feel the pain of 2022's interest rate hikes, which JP Morgan Chase Bank says that we haven't fully felt yet. And they're saying that number one, we still have to feel more of that pain. And number two, in order to really bring inflation down, we're going to have to see more of this economic pain. What they said, a recession, that it might be necessary in order to bring inflation down. And the reason why is, well, you can think about it. especially with housing prices. Because CPI, or inflation data, is made up of a lot of different components, and one of the main components in that is housing. So when you have a lot of people with money to go out and buy a home with low interest rates, what happens? Everybody wants to buy a home. Now you have a home listed for $400,000. You have 35 different offers, and the home sells for $475,000. Home prices go up. Now when home prices go up, that data goes to the inflation, the CPI data, which says home prices went up. Inflation is higher. When inflation is higher, the Federal Reserve Bank has more fuel to continue raising interest rates. So now, when you have, say, higher interest rates, demand starts to go down. But it hasn't gone down to the point where we're seeing inflation really fall to the levels that the Federal Reserve Bank wants. This is why the Fed keeps saying that bringing inflation down has not happened yet, and it's going to take more work. So now what happens if you have a recession? If you have a recession, now that means the economy is slowing. And generally that would mean that less people are going out to buy homes. And generally that would mean that, well, sellers would be having to cut the prices of their homes to get their homes sold. So now let's play that scenario together. If sellers are having to cut the prices of their homes, home prices would generally be falling. If home prices are falling, well, that's going to go to the CPI data that says home prices haven't risen, they've fallen. What does that do to the inflation numbers then? That's going to cool down the inflation numbers, because now instead of seeing more prices of things growing, we have the prices of some things falling, which would help average out to hopefully a lower inflation number, at which point then there's less fuel to continue raising interest rates, because then you have some corrections in the inflation numbers. This is where JP Morgan is saying that we need a recession to actually bring inflation down to the 2% target, because what they're saying is that the current efforts by the Fed are not enough. The current interest rate hikes are not enough. The current quantitative tightening has not been enough to bring inflation down. Now, we did a full deep dive of this story in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, it's a free and easy way for you to stay up to date on what's happening in the economy, the housing market, the stock market, and the global economy. That way you don't get blindsided about what's happening, so you can be on top of what's happening when it's happening. You can read the newsletter in 5 minutes every morning, and it's completely free. If you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. In June of 2023, we saw our stock market hit a brand new bull market, because we saw the stock market constantly going up and up and up, and everybody said, oh, all these recession worries are gone, the economy is booming. But you have to pay attention, not just to what's happening in the noise and the news and what banks are saying, but you have to pay attention to what actually smart or real investors are doing. Because, well, JP Morgan has a lot of insight. So let's see what they're actually doing. They said that they're maintaining a defensive asset allocation and believe the risk reward for equities, meaning stocks, remain poor given the disconnect between stocks and bonds. There's a high likelihood of a recession in the coming quarters. There's high interest rates, tightening liquidity, and rich valuations, and the still narrow market breadths. There's a lot of things that they said in that one sentence that I really want to break down, because now you can really understand now if this is the largest bank in the United States and they're making investments based off of, well, not what's happening in the current state of the markets, not what's happening in the news. It's something for you to pay attention to, because we've heard a lot of news, especially when the stock market's going up, that the economy is booming and everything is great. And what does that really mean? Because what you have to understand is that recessions don't happen when people expect them to happen. They happen when people stop believing that they're going to happen. And what JP Morgan Chase Bank is saying is that the investment into equity stocks still does not seem like the best investment for them because of all the factors that they highlighted. They talked about the likelihood of a recession coming in the coming quarters. What does a recession do? That generally brings asset prices lower, stock prices lower. So because of that, they said this might not be a good time for them to be dumping a ton of money into the general stock market. The second thing they said in that same sentence is higher interest rates. What do higher interest rates do? They make borrowing more expensive. They cool down demand. And what they're also saying is that we still have to feel the full effect of the higher interest rates, which we haven't felt yet. So they're saying that we're going to see more pain coming because of the higher interest rates. Third, tightening liquidity. Tightening liquidity means less money entering our economic system because banks are less likely to loan money. Banks are going through their own regulations to bring less money into the economy. That means less spending, less ability for people and companies to buy assets, less ability for people and companies to spend, Less spending means less economic growth because our economic system is designed on spending. The more money you spend, the richer somebody else makes. And when you have tightening liquidity, there's less spending ability, which means people and companies have less ability to spend money, which means less growth in the economy. And then they said rich valuations, which means essentially that they still believe that the stock market is overvalued. They say the stocks, essentially companies' valuations are too high, and because of that, they're not investing as aggressively into equities right now. This is directly from JP Morgan Chase Bank. Now, you don't want to blindly follow what they do. You don't want to blindly follow what I do. You don't want to blindly follow what anybody does, but rather understand the different opinions out there. That way you can make the best decisions for yourself, because guess what? When the stock market is booming, you start to see the sentiment that, oh, the economy is not going to see any recession, that the world is great, everything is fine, and nothing can go down. As soon as you start to see the stock market slightly go down, things flip. Everybody says, oh, we're going to enter a recession. Everything is bad. Everything is going to go wrong. The whole world is going to end. And this is where you, as a financially educated person, have to be able to cut through the noise, cut through the emotion, learn from different people. Some people think that the world is going to end. Some people think that the world is going to boom and the economy is going to boom. And you have to be able to find the right information to help guide your investments. Instead of being an emotionally driven investor, be an educated and financially driven investor. What we know at the time when we're recording this video is that while inflation is still high, we're seeing the economy slow down, and we're probably going to see more interest rate hikes coming. The Federal Reserve Bank has made this very clear that they expect to raise interest rates more in the future. These higher interest rates, again, make borrowing more expensive, which means less spending, which means a further slowdown in the economy. And at the same time, now you look at what's happening in a job market, and you might be saying, well, none of this is making sense. We're having the slowing economy, we have inflation, we have all these problems that people are talking about, but companies cannot find enough workers. People can get jobs. How is this all adding up? But you have to now put this all in perspective based off of what's happened over the last few years. Remember, JP Morgan hinted at this too. We have seen so much money printing, especially from 2020 to 2022. Now, what did this money printing do? Well, of course, it gave people the ability to spend, but it also gave businesses the ability to spend, right? We saw billions and billions of dollars given to these corporations and businesses around the country. Now, we're handed so much free cash with zero strings. What are you going to do? Well, some obviously use this in bad ways, but businesses that are smart are going to take this money and they're going to want to invest it into new divisions, new stores, new manufacturing, new research, which means new employees. So we saw all this money enter our economic system, and no crap, we saw this huge boom in the job market because businesses had so much money to spend. They had the ability to create new jobs. And this is what the Federal Reserve Bank is working to correct. They're working to change what happened in the last few years. They want to cool the labor market. Why? Because they feel like too many jobs were created, that's also fueling the inflation problem. So what do they want to do? They want to correct that. They want to correct that through demand. Because now, if Chipotle has less people walking through their door, there's going to be less people spending money, or less money that's going into Chipotle. If less money is going into Chipotle, they're not going to be able to open new stores. They might have to shut down some stores. They might have to shrink some of their research or some of their tasting departments, which means less jobs needed at the company. Now, I'm just talking about Chipotle as a hypothetical, but that's essentially what higher interest rates do. They cool down demand, which cool down spending, which cools down the economy. And this is what JP Morgan is highlighting, that you don't want to just pay attention to short-term movers in the market, because there's a lot of things that can influence the short-term moves. The stock market is very emotional, but you got to pay attention to the trends. There's a lot of money that was created in 2020, 2021, and even into 2022. It's going to take time for that all to kind of fizzle through our economy, and then for the higher interest rate effects to be felt. And not just that, we're still raising interest rates. So now as interest rates go higher, we're going to start to feel the effects of previous interest rate hikes, and then we still have to feel the effects of the more recent interest rate hikes. These things are going to take time. And this is where JP Morgan is saying that they're anticipating opportunities coming in the coming years because of everything that's been shifting in our economy. Now, a lot of people don't have that patience to sit there and watch it happen. They want to see either the crash tomorrow or they want to see the boom yesterday. And this is where you got to be willing to be patient and understand what's happening. That way you can actually capitalize on this. And this is where you want to pay attention to what some of the different players are doing. You want to pay attention to what people are saying and not get caught up in the noise, not get caught up in the emotion, and not just blindly follow what anybody else is doing. Now, of course, we're keeping you updated at Market Briefs. That way you can stay up to date on what's happening, when it's happening. But this is where your job as a financially educated person is: number one, get prepared, and number two, be financially educated. I say that 2023 is not the year for you to go out and finance a brand new truck, because this is the year for you to get financially smart. That way you can get prepared of putting money aside for your investments, putting money aside to capitalize on more investment opportunities. And then number two, building your financial education. That way you can actually see the opportunities when they happen. Because, well, you can have the money put aside, but if you don't know how to find a good investment from a bad investment, it doesn't really do you any good. And that's where you need to be investing in your financial education. Learn about investing, read books on investing, maybe take classes on investing, and then do it yourself, because you cannot bypass the experience. That way you can then have the ability to capitalize on opportunities and have the education to find the opportunities, because those two things together can help you dramatically increase your wealth, because you might be able to find great investment opportunities at a huge discounted price.
If you're broke, most people will tell you that you need to, number one, go out and earn more money, and then number two, go out and get a 0% APR credit card and move all of your debt there. But this is the worst thing that you can do right now. I'll show you. Right now, the majority of Americans are broke. The majority of Americans have little to no savings, and the majority of Americans have little to no investments. This is where